as Amy said, my name is Brad Burrows, partner with Eide. I'm excited. This is really the first CPE of this type that we've issued. Geared around public pensions, investment-heavy type investments, investment pools, 529 plans. But we also recognize that a lot of local government have pension plans floating around, so we've got a wide mix of participants joining us today. With that, with this being our first one of hopefully many, we do appreciate any feedback that you have. We'll be reaching out afterwards, and so appreciate any comments you have, as well as possible topics for the future. If you don't have any topics now, if anything comes up during the year, we'd love to hear that from you, so reach out to any one of us, and we'll try and get that on the agenda. And with that, I will turn it over to Lee Miller and Paul Skeen to get this going.
Fantastic. Thanks, Brad. Appreciate the opportunity. Amy and I think it would be kind of cool to just keep that music going through the whole thing, kind of a dancing GASB update. Would be exciting. Appreciate everyone joining us for this presentation. Like Brad, I'm excited to kind of gather a common group of practitioners and share some thoughts that we have on topics that we feel are most applicable to this group. By way of introduction, I'm an audit partner in the Utah audit practice. I office out of Salt Lake City. And Lee, I'll let you introduce yourself as well quickly.
All right. My name is Lee Miller, and I'm audit partner out of Boise. And like Paul, I'm excited about the opportunity to be able to meet with everybody today.
Okay, thanks, Lee. We'll jump in. I failed to wish everyone it's a special time of year. It's Masters Week, so if you've got your leaderboard in the background, I understand, but we do have a lot of great topics. So happy Masters Week, happy spring, all of that. Jumping quick into the topics at hand, we like to do this heat map. Kind of helps us see where we're at with upcoming standards, what's going to be high effort, what should be pretty straightforward. And you can see the coding there at the bottom. These areas that are indicated by green shouldn't be too heavy a lift. Again, regardless of level of effort, you want to look close at your situation. These are all facts and circumstances, and so really evaluate how it applies to your entity. But this is our assessment generally of how these will apply. The one that the red should get your attention, the GASB 96 on CBITAs. We're going to do not a deep dive on 96 today, but we'll cover it in some detail. 99, depending on what type of entity you are, and again, facts and circumstances, what types of activities you have, that could be a little more effort. We'll go through the things that we think are the biggest triggers there. And then also a little farther down the line, we've hit the century mark with GASB pronouncements. I have been in the profession long enough to have vivid memories of GASB 34. That was the first one that seemed like it was going to change my life. So to be at 100 tells me that I need to start preparing for other phases of life, I guess. That's a lot. Lee will dig into 100 a bit, and then also 101. 101 is going to be interesting, I think, because every jurisdiction, every entity has its own policies related to compensated absences. And that's why we've said this is going to be a medium effort. For some, it may be very simple, but depending on the complexity of your compensated absence structure, it could be a fair amount of effort. And then looking down the line, the first topic there we're going to hit on in regards to GASB 87, 94, and 96. There is an exposure draft on the implementation guide that is actually being discussed, or it was discussed by GASB this morning. We'll talk a little bit more about that. But then there are a few others to be cognizant of, have on your radar, so that when we start digging in, they become final. It's not the first time that you've heard about them. Okay, GASB 96, subscription-based information technology arrangements. I've heard it pronounced a few different ways. I don't know who's right, but I've heard Eric, who will present later, call it CIBIDAS, and he is the ultimate expert on said things. So I'm going with CIBIDAS. We'll probably all develop our own way of tracking and figuring out those things. But let's do I'll call it a medium dive on CIBIDAS. These are things that we all are very used to using. One of the interesting things about GASB 96 to me is that this isn't replacing any existing guidance or codification. This is new, but as we dig into it, I think you'll find that it doesn't sound completely new. There's a lot of real nuanced evaluation that needs to take place with this. And we'll hit on kind of some of the highlights of that. And as we think about what are some of the common CIBIDAs in use, what things will this apply to, what arrangements will this apply to, I think we all probably recognize the vast majority of the logos on this wheel. You know, a lot of us today we're using software as a service in Zoom, and a lot of us use Workiva to do our financial reporting and these other things. Additionally, you've got the platform as a service, where you've got hardware and software tools available via the internet through a third party. Our infrastructure as a service, those are the bigger systems, the ERPs, the Oracles, the Citrix, Cisco, tend to be large storage, networking, virtualization tools. And then that last quadrant, the data warehouse as a service, gets into the data analytics. Snowflake is an Eide Bailey partner that we work with extensively, and the services that we offer around data storage and analytics. And certainly if that's an area that you're interested in or wanting to know more about, that's not what this webinar today is, but any one of us would love to talk with you about some of the offerings that we have there. It's a pretty exciting world, and neat to see what some entities are doing with data warehousing. So those are all the types of arrangements. And looking at what is the definition, let's dig into what it is. And if we were in person, I would do a little informal poll here at the end of this. So the definition of a CIBIDA is pretty straightforward. It's a contract that conveys the right to use hardware, software, or a combination of those for a time period that is specified in the contract in an exchange or exchange-like transaction. So this is where I would do the poll. If we were all sitting in a room together, I'd have everyone raise their hand that this terminology sounded familiar to, and then I would shame everyone that didn't raise their hand, because this sounds exactly like the lease standard. It's very similar. So a lot of the wording as we dive into 96 and as we start to dissect it, you'll see that some sections are cut and paste right out of the lease standard. It's a very similar model. So we've got this suite of standards in GASB 87 for leases, 94 for public-private partnerships. We'll call them PPPs through the rest of this, and then GASB 96 that relates to CIBIDAs. All of them have similar elements, and we'll compare and contrast a few things here in just a minute. But one of the interesting things that's unique to the CIBIDAs is there's an opportunity for, not just an opportunity, but most often if we're implementing a new software system, let's say we're putting in a new ERP, we don't just plug it into our computers and go live across an entity. That would be fantastic if that were the case. But as any of you that have done that know, you just don't ever hear, oh, well, that was easier than I thought. There's a lot of time and effort. And so GASB 96 lays out these three phases on how we deal with our expenses before and after we go live. One thing to recognize up front is that training in all cases is expensed. So throughout the time, GASB looks at that as a period cost, and so the training time always expensed. Otherwise, the GASB 51 model is applied, where we've got a preliminary stage where we're deciding which software to use, which modules from within a system we're going to apply, who's going to have access, all of the decision-making process. Once we've made that decision, we start to do the actual coding, the actual loading onto machines, all of the work where decisions are no longer being made, but it's actual development time. We capitalize that, and we'll call it a prepaid asset. It's like construction in progress if we were building a building. We're going to capitalize all those costs until the point where we go live. Now, once we go live, we're going to then, any outflows unrelated to just the traditional subscription payments would be expensed, and unless they would either change or increase the utility or the life of the arrangement. So we're essentially developing an asset in the meantime. Now, if we compare some of the nuances of 87 and 96, leases and CBITAs, our CBITAs really already meet the definition of a lease. Right out of the gate, they meet the definition. But one of the unique aspects of it is the multiple components that can be involved. Most of our arrangements, not most, but a lot of our arrangements have both a hardware component and a software component. And depending on the significance of both of those to the arrangement, it will direct us either to 96 or to 87. So if we've got tangible assets alone, we're obviously in the lease standard. If we've got software alone, we're obviously in GASB 96 for CBITAs. When we get that combination, unless software is insignificant compared to the total overall cost, we're going to go with 96. Now, if the software is incidental and it's insignificant to the underlying tangible asset, in that case, we would go with 87, the lease standard. Now, one of the things that I personally am relieved about with 96, and I'll be vulnerable and disclose my own weaknesses here. Whenever we would be going through an audit and we would be dealing with the lease and helping some of our clients in consulting arrangements, I would always have to mentally switch, okay, are we the lessor or are we the lessee? And just mentally had to do that. There are differences in how GASB 87 applies to both. We get a pass on 96. We don't have to apply this for vendors. Now, a lot of times we think, well, governments aren't vendors of software, and that's not necessarily true. They do exist. I can think of a statewide education system that requires all of their school districts to use a software, and they pay for the software. They pay a subscription arrangement, but they don't have a choice. Anyway, we'll get into the legality of that, I guess, another time, but they're required to use the state provided software. And I've got a polling question there. I didn't hear a beep or anything, so I'll be your manual beep during our presentation. But vendors are excluded. And so we're just looking at this from the subscriber standpoint. One of the things that we'll get into when we talk about the implementation guide that is proposed and looks like it will go through is there's some short-term guidance that needs to be cleaned up in the lease standard that's actually included in GASB 96 for CBITAs. And we'll talk a little bit about the that's a tough one, the potential perpetual licensing that may exist in some agreements. And then keep in mind the implementation date. This goes live for periods ending after June 15th of 2022. So our friends with June 30th year ends will be the first to apply this for June 30, 2023. We're not going to go into a deep dive on the accounting for CBITAs, but I'll do just kind of a real simple discussion to illustrate what the accounts we're going to be hitting. So similar to a liability, we're going to calculate our lease liability, or we're going to similar to 87, excuse me. we're going to calculate our lease liability based on the present future value of subscription payments. And again, that becomes nuanced into what's included. It's pretty straightforward for the most part, but again, you need to really pay careful attention to your agreement to figure out the fixed, variable, guarantees, rebates, any of those things that factor in. So we're going to go through that calculation and determine our lease liability. For just rough purposes, let's say that's $15,000. Then we go over to the asset side. We're going to start with that $15,000, and then we're going to add to that any prepayments or capitalized initial payments or costs that were accumulated during the development phase. So we've got our debit for $17,000, our credit for to the subscription asset, our credit of $15,000 to the liability, and then we're going to relieve that prepaid asset for $2,000. Again, vendors are scoped out of this, so we don't have to worry about the other side for vendors. And then our periodic reporting, once we've got our CBITA liability on the books, we'll amortize that asset over the shorter of the useful life of the CBITA or the term. And again, there are some nuances to figuring out what the term is, but that's our amortization period. And then we reduce our subscription payments or our subscription liability by our payments using the effective interest method. Okay, so going back to the idea that 94 for PPPs, 87 for leases, and 96 all kind of have the same things, a similar structure. I think it's good to highlight how many similarities there are. So we've got, at the start of all three of these, we need to determine what types of contracts we have. If the agreements are in scope, we need to make sure that in reviewing those contracts, we understand the definitions. Term calculation becomes critical to all of them because there are different options for terminations, extensions, cancellations, incentives. All of those things factor in, and then the actual calculation of the liability is very similar for all three. Now, one thing, again, we highlighted a little bit in my rough example of the asset that can be created during the development phase. That's unique to subscription assets, that we can have that second intangible asset for our development costs. Then a lot of the other things become very standard. So I alluded to the fact that GASB was discussing a proposed implementation guide update. Comments were due in January. This was on their board agenda today. I don't know if Eric listened in, but it sounded like he did just enough to know that it sounds like these questions that were proposed will go through as proposed, that there wouldn't be significant changes. There may be some minor changes and cleanup, but in general, they're as proposed. Now, one of the things that I want to highlight that is kind of interesting on the CBITA side is the question was asked, is a licensing agreement for a vendor's computer software that automatically renews until canceled a licensing agreement that provides a perpetual license? So again, I can think of a lot of examples here on my phone that they just automatically renew. I can opt out at any time, but they automatically renew. So the answer is that the provision that automatically renews until canceled contains an option to terminate that doesn't require the other party's permission or agreement. And so in that case, the licensing agreement becomes cancelable at the subscriber's discretion and does not provide a perpetual license. So interesting there. And if the second point there, if that is the case, we then look to what that means to us. It then triggers the idea that this is a short-term, assuming that is an annual renewal, 12 months or less, it becomes a short-term CBITA. And anything else, regardless of their probability of being exercised, would be outside the scope. And so that would be determined based only on the non-cancelable period. So if I have a software agreement that on June 15th of every year renews, unless I do something before to cancel it, that's going to be a 12-month or less arrangement. So we already kind of talked about the different accounts that will be hit through this. And so let's jump in to GASB 99. There are a few elements that are implemented immediately and a few that are coming up. I'll talk about the ones that are on us right now, and then Lee will talk about some of the ones that are upcoming, and we'll transition to him at that point. The LIBOR link is contained in here. Again, LIBOR is expected to sunset. There's some rumblings that could be extended again. So keep your eyes open for that. The SNAP distributions have had their own GASB code that will cease to exist. Again, SNAP is the Supplemental Nutrition Assistance Program, so likely not super applicable to this group, but there may be a few of us that have that in our entities. So those will be treated like non-exchange transactions going forward. An interesting one that often gets ignored is the disclosure of non-monetary transactions. There will be a requirement to up our disclosures related to those, and a lot of entities don't disclose those at all. The example would be if you're a municipality, you trade the old sheriff truck in for a new sheriff's truck. There may not be money exchanged, but there may or may not be, that is. So increased disclosure requirements there. The next point, revenues pledged from blended component units not received. I think that most have handled this right, but apparently not enough to keep it out of a new GASB. But that would be reclassed as an interfund payable or receivable, depending on which side of the transaction you're on. And then, as in most omnibus statements, there's some terminology that's cleaned up. There's some clarification that in a government-wide statement of financial position wouldn't be appropriate to have a total column between the business and governmental type activities. That can potentially be confusing. So now let's look at GASB 99 as it relates to our suite of lease-like standards, 87, 94, and 96. There are 5 points there that I'll quickly cover in the next few slides, and then just remind you that this implementation is expected for periods beginning after June 15th of 2022. So again, our June 30 friends will be the first to implement in 2023. Early implementation is allowed for GASB 87, but you would also need to implement it for 94 and 96. So be cautious as you do that. And you'll be able to see as we go through these some potential areas that you might want to consider that. So to help clarify which of the three, 87, 94, or 96, we've got this blue bubble that will tell each point which applies, which standard applies, and which it doesn't. So the first one, all three. Options to terminate do not include options that will be exercised only upon certain events occurring. The most common would be a default provision in a lease. That doesn't cause us to include that as a termination option. The second one only applies to leases that if there's a purchase that is likely in the future, we need to evaluate that as a possible extension of the lease period, meaning there's not a provision for it. They've got an option to purchase and it's reasonably certain to be exercised. We need to reassess our lease term calculation at that point. And then the last one is a very slight chance of much happening, where we purchase all of the underlying asset, the payment of all sums due or paid up front, or a default. So very narrow focus there. With our short-term calculations, we kind of covered this before within 96, is that if it's cancelable, we do not consider that part of the term calculation. So this would be for leases and CBITAs. Interestingly, I think the second point is kind of a helpful clarification, that if a contract was originally considered short-term, so let's say we've got a 12-month lease contract, it expires in 12 months, and so we've classified it as a short-term lease. And 2 months into the lease, we modify the terms of that lease to now be an 18-month lease. What we need to do is we need to go back to the first of the original contract and remeasure from that date. So we essentially treat it like an 18-month lease. So now, instead of a short-term lease, it's a long-term lease, which causes a completely different set of application. Okay, this is a great clarification on variable payments. It helps to clarify, and again, number one applies to all three leases, PPPs and CBITAs, that if we've got a variable payment that's tied to an index or a rate, or it's got ceilings or floors in it, those variable payments are included just as part. They wouldn't require remeasurement. All other variable payments would. So if we've got a rate or a payment system that's tied to CPI, that's going to not cause a remeasurement each time that the consumer price index changes. So we don't remeasure for that change in the index. We don't remeasure for a change in incremental borrowing rate. So good clarifications there. And then that second point applies to PPPs only. And in the interest of time, I'm going to skip through that, as I don't think that will have broad application. So I alluded to the fact that we need to be real careful with lease incentives earlier. GASB 99 codifies some of the questions that were asked in the FAQs. Within 96, I think I might have just said So in 87, we had a lot of frequently asked questions about lease incentives and how they should be handled. Those were addressed there. This essentially takes those questions and moves them up to level 1 gap or level A gap, and clarifies that within the lease incentives, we've got rebates and discounts, this list of things that you can see here. One thing to keep in mind is the legality of these. And so when you start to get into lease incentives or subscriber incentives offered by vendors and CBITAs, it's not a bad idea to have your legal team involved there. There are cases where those incentives have been deemed to be bribes. That would probably most often fall under the other reimbursement of costs category. So be real careful there. And the last thing that I've got here is just a kind of a one-page checklist on which parts of GASB 99 apply to each of the lease standard, the PPP standard, and then the CBITA standard. And so with that, I will turn the presentation over to Lee.
All right. Thanks, Paul. Appreciate the information you've provided so far. So I'm going to cover a couple more other items within GASB 99. It's always interesting with these omnibuses type of standards. It's almost like it's more of an oops. GASB's gone through and decided, oh, hey, we are starting to see things that we didn't take into consideration. People start to early implement and are finding issues, questions come up and everything like that. So it's always interesting to see when these things are coming out, what kind of things are going to be affecting and everything. So one of the things in GASB 99 is way back when in GASB 70, they came out with some guidance when it came to guarantees and how to treat them. And at that time, GASB had just decided they just wanted to do the well, right, the one that they're addressing are the exchange like, so it's the non-exchange types transactions, and at the time people had asked the questions, why aren't you addressing the exchange versus exchange like questions at that point in time? So with 99, they've basically said, okay, we're now going to for those that do have guarantees and it's an exchange or exchange like of a financial guarantee, you're basically going to follow what's going on in GASB 70 of how you're going to treat those things, so that if you're an entity that happens to have a guarantee, this will be driving what you're going to be doing going forward. So not really anything different, other than they've actually brought in the exchange like transactions. Derivatives. I think for most pension plans, everybody has some sort of a derivative instrument. For those, from a pension, investment pools and so forth, typically we're dealing with your investment type derivatives. And so you are recognizing any change in, your gains or sales or the fair value that's incurred during a year. We're running all that through the income statement type of a transaction. So in 99, however, on the other side, there's also hedging derivatives. And so 99 was addressing those people that say they had a hedging derivative where you don't run anything through the income statement. Everything is run through a deferred inflow or outflow, depending on the direction of your derivative. Well, what happens if that derivative gets terminated for whatever reasons? What happens? How are you supposed to be treating that? And so if you happen to have an effective hedging derivative and it gets terminated, now you're going to be treating it like it's an investment type derivative. So for most of us that are already dealing with investment type derivatives, it's not going to be anything new, but they did come out to be able to at least address that issue when it comes to your derivatives. Now, one of the other things that they've done here, when you're implementing new standards, there's usually two things that they address when it comes to implementation timing and dates. They always talk about for the period beginning after, and that's from an annual perspective, but then they also will address, there are a number of government entities that do submit interim period financials. And so they would typically address, well, what interim periods do these standards apply to? And so what they have changed with 99 is that going forward, it's going to be after the certain date is from an annual perspective, and no need to implement new standards on an interim financial reporting perspective. So for those that are issuing financial statements on an interim perspective, this will apply. For most of us, since we're only doing it on an annual basis, we're not going to see anything different going forward. The other thing that's always in the implementation section is discussing the fact of, is this prospectively implemented? Do you go back and is it a prior period, retrospective? And so they always spell that out. Well, with the new GASB number 100, when it comes to the counting changes and error corrections and so forth, now they're just going to be referring to GASB 100. And so that's just, again, you'll just see that changes in the wording for going forward. Now, if 100 does not apply, then GASB will state that, but for the majority of the times, it's just going to be directly back to 100. So this is just some technical aspects of things that they're just clarifying and with the changes that are happening. All right, so GASB Statement 100, the century mark. Like Paul Mentioning remembering 34, I happen to go back a few years before that, but it is just hard to believe that the number of the different standards and things that that we're seeing and everything. So with this standard, for years when it came to, if we had a change in reporting entity, we had an error that we need to go back and correct and do a prior period adjustment. We were basically using GAAP that's from 50 years or more ago of what drives how do we treat that? And it was really, and of course back then it was written when there wasn't a GASB. It was more for the for-profit type of a perspective and everything. Since then, with with GASB 34 and the addition of RSI, and other type of things that aren't typical under your FASB for-profit type of reporting. So the standards at that point in time did not address, how do we deal with RSI, or how do we deal with other information of what's going on within the statistical section and so forth. And so, especially when we're dealing with comparative statements, how do we address all these things? And so GASB 100 was issued to address these. So there's the different types of accounting changes. We've got a change in accounting principle. We have change in the accounting estimates. Or also we've got changes within financial reporting entity, which is one that they really don't see from the FASB side of things. And so, this standard was there that was needed to address this. And then of course, what happens when we have a correction of an error? And currently, GASB 62 addressed some of the items when it comes to correction of an error. And so GASB 100 was trying to bring all of these things together and to be able to address all the different issues specifically for GASB, and to help us to be able to apply if we're dealing with these type of changes going forward. All right, so change in accounting principle. So what is it? It's basically, it's changing when you have one GAAP principle to another, when both are acceptable, but one is preferable to for it. So and what would be an example of a change in GAAP principle? One would be, maybe you're going from, you happen to be heavy into an inventory, and you've got you're going from FIFO to a LIFO method. That would be a change from one acceptable GAAP method to another. Within the governmental GAAP, there really isn't a whole lot of these, but it could be some unique circumstances and so forth and such. But that inventory is one that would be one example. Or let's say if you have some capital assets, and for whatever reason you decided that you wanted to go from a straight line to the summary of years type of a depreciation calculation. That one's a stretch, but it would be an example going from one GAAP to going to another. Then of course, when we're implementing a new GASB standard, that is basically a change in accounting principle. And so when we're going from one GAAP to another, we need to take into consideration the reliability. Is it relevant, timely? You need to be consistent. You can't change one year and change back the next year. Is it comparable, and is it understandable? And so those are some of the things to be taken into consideration when we're going from one principle to another. With the implementing a new GASB standard since 87, is usually a paragraph explaining what's going on, and then also a paragraph if there was any change to your beginning net position. Those are the type of things that you're going to be showing and going forward when it comes to a change in accounting principle when it comes to new standards. All right, change in estimates. And a majority of the time when it comes to change in estimates, these are applied prospectively. Let's say if you got a change in depreciation lives, if you got a change in, there are significant changes for your underlying data and assumptions. Let's say for instance, you happen to have your own pension plan as an entity, and the actuarial changes and so forth. All those things are done prospectively. You don't go back and restate. You provide some of the information what's going on. As you can see with this slide, you've got where there's new data that occurs, you've got some more experience, and there's sometimes you do have methods that you can change to. So it's a little bit of a change in counting principle, but since it's a method within a determination or a calculation of an estimate, then it's usually under this accounting estimate. But there may be some new methods that are more preferable to the old methods. So with the accounting estimates, again, like I said, it's going to be looking forward. Now, this is a unique circumstance, more for your governmental side than you do for your for-profits and nonprofits and so forth, is that the change in financial reporting entity. We're talking about, well, if we're adding, or maybe we're shutting down a component unit. We're removing a fund for continuing operations. It's, for example, in the state of California, they came out a few years ago where they had redevelopment types of organizations that were set up. Well, the state of California came out with a statute that said, hey, those types of government organizations can no longer exist. Well, then you had to change all that to move it over to the general fund. So that's changed from a reporting entity. For those that deal with major and non-major funds, you've got to go from, that it can change year to year depending on the operations and so forth. And there really wasn't a standard out there to address this. And then also we've got our blended to discrete or vice versa when it comes to component units. So, the GASB 100 addresses how do we look at these things, how to report them, and what is the footnote disclosures that we need to address. Now, what's interesting, yeah, thanks, Paul. I guess I paused too long there. But anyway, when it comes to mergers and acquisitions and majority equity interests, that is different from a change in reporting entity, and those respective standards address how you're going to treat those and moving forward. Okay, next slide. All right, correction of an error. This happens. We mistakes, we make mistakes, as entities, whether it's sometimes it can be a math error. It's, GAAP isn't, rarely is it ever straightforward and clear, and so maybe we didn't implement GAAP properly. I think we're going to be seeing a lot of that when it comes to GASB 87. And I'm already seeing it with a couple of my clients where what our understanding of the lease agreement was, we've taken a look at it differently and said, oops, that probably wasn't implemented correctly. We got to add some. We haven't found anywhere we got to take them off, but it looks like we're going to be adding some. Well, that would be in a correction of an error, or, there was the information that at the time when we were implementing or doing a transaction, better information or the right information came to our attention, so that we need to go back and do that correction of an error. It happens. I know we all like to think as accountants and auditors, I mean, we're going to do things perfectly, and we're going, we never make mistakes, but we do, and things happen and everything. And so GASB 100 helps be able to identify how to treat that, what needs to be disclosed. One thing about the error is that it's going to be different in the amount of information we're going to disclose. Whereas before it was just a change in the net position or in the fund balance. Well, now we're going to be needing to show what's changes in the RSI and everything else. And so when that happens, it's going to be a little more complex of a footnote disclosure and everything. But at least this addresses from a government perspective. So a quick heads up, there is polling question number 3 that is out there. GASB 101, compensated absences. Now this is a standard, and you can go ahead and go forward, Paul. It's been out there for 30 plus years. There was an inconsistency of how things were being applied. Also, a lot of different changes of PTO. You know, it used to be it was just vacation and sick leave. Now we've got unlimited, we've got sabbatical, we got floating days, we got leave banks. You know, so all these different things that are going out there. Also, when it came to the footnote disclosure, since compensated absences were included in the long-term liability roll forward, you know, a lot of those numbers were fudged, as if you want to call it that. Some people were like, you know, beginning balance, that was the decreased amount, the ending balance was the increases, or people would figure out, well, we know what what was the increases, so you know, we've got the you know, we've got to fudge the decreases to get to the ending balance. So all those things were being taken in consideration under 101 and how to address that. Next slide. So this is just briefly a slide showing about the different types of compensated absences that are out there that this standard addresses. And then there are different ways to be, how will be the liability going to be recognized? You know, you've got some that the balance where you accumulate, and you got some PTO that it can be carried forward from one period to another, and it gets settled in a future period. We've got ones that are attributes that where the liability is related directly to the services rendered by the employee. So the employee is earning a you know, the compensated absence, and they're earning it, so you're going to be recognized, and of course in period. Nothing new here, but that's what they're just breaking out and trying to explain it so that it can be applied to all the different circumstances and everything. So one of the things that they did change is that under the old GAAP, it was probable. Now it's more likely than not. So which is just barely above 50% that they're going to be paying it. You know, then you're going to be recognizing the, you know, the liability. Next slide. Well, you know, on note disclosures, we always hopeful with that there's going to be less note disclosures. There's going to be a little bit, but anyway, it's still, we're still going to be doing a roll forward at the beginning, ending balances. Now you have a choice. You can provide the increases and the decreases, or you can do a net number, and you just need to disclose that, yeah, we're doing the net amount. Of course, we always, we're disclosing the portion that's going to be due within the next year, which is our best estimate at that point in time. And one of the old disclosures is about the fact that if you had multiple funds, which funds were they being paid out of, and you don't have to disclose that anymore. So those are the standards that have been issued, the ones that we're going to be seeing, you know, that Paul walked us through, and we've seen that the table of those that are coming up. And so that'll get us through 101. So now looking into the future, what are some of the things that we're going to be seeing that could affect this? Again, this is just giving you a heads up. There's still a lot of discussions going on, a lot of debate. A number of these things you'll notice that are things that they've been discussing for 9 or 10 years, type of a thing. So one of the first ones I want to just bring up is the certain risk disclosures. You know, I think for pension plans and investment pools, especially if you're working in with alternative investments and everything, you know, if you meet certain criteria, there might be some additional disclosures that could that will need to be made. Again, exactly how that could affect the plans and entities, they're still trying to work through that. You know, where do you draw the line? What is a for one entity might be a huge risk perspective versus another, it may not. And so they're trying to work through that. But just be aware that you know, going forward, we're going to be looking at and doing a critical eye as to things that are going on. Is there a risk that could be associated with whatever the transaction may be going in, and will it need to be disclosed? Which kind of dovetail into the other area that they're looking at is the going concern and severe financial stress. You know, we really don't hear of government entities that that are going concern or that file for bankruptcy. It does occur. The perception is, and everything is the fact that governments don't fail, but some do. And so GASB is trying to decide, okay, is there enough that where we need to come out with the standard to be able to say, okay, if these things are going on, then there needs to be some sort of disclosure. There needs to be some sort of discussion. And what are those things that would need to be triggering that would indicate that there is a potential going concern? Well, but also at the same time, while it may not be a going concern, they're also trying to decide, well, is there a severe financial stress? Let's say, for instance, with all the banking problems that we've been going through with a few of the banks going under, let's say if it happened to be even a bigger issue, and it was causing cash flow issues and so forth for a particular government entity, is that a severe financial stress? Is that something that needs to be brought to the attention? Um, and so those are some of the things, and there's a lot of varying and differing opinions of what is severe financial stress, what should be disclosed, how, at times GASB was considering about, you need to project, 10, 15 or 20 years into the future, and maybe showing that you might have some financial stress down the road. All these things that they're trying to discuss here. Pension plans that are where the net pension liability overall for the plan, or the being you're less than 50% funded, is that a financial stress? So all those things that are going to be taken in consideration going forward. They're trying to clean up a few things, classification of non-capital assets, basically when we're talking about with the leases and how to properly present those. Same thing when you got to, whether as Paul pronounces EBITDA, or if it's a SPIDA or whatever, what's the classification? How should it be reported? Some people think it should be split out even more than what we're currently doing, but this is something that they're taking a look at. Again, it's going to be more of a footnote disclosure than anything else. Now, this one they have been working on for at least 9, possibly, almost close to 10 years. That started out like, hey, GASB 34. We want to retake a look at it. Well, they're still debating, still trying to work through it. They're also working on the revenue and expense recognition, for pension plans, investment pools, your 529s, everybody from that perspective. Right now, what we're looking at, it probably isn't going to change much from the financial statement presentation. There might be some changes under revenues and expenses, but probably anything significant. But just be aware that it's out there and that it could change. But right now, there really isn't even anything solid enough to be able to say, yeah, this is what they're really looking at. They keep fine-tuning it, keep coming with questions, keep going back and forth. And so it's almost a full-time employment act for the GASB staff trying to work through and trying to determine how this is going to look. But from a pension plan side of things or investment pools, it's probably not going to change a whole lot at this point. All right, so those are all the different things that that we were going through. From a GASB update, things that are out there, things that can be aware of what's going on. I think just to reiterate the fact that the biggest one, of course, for most everybody this year is going to be with the SPEDAs and everything. And so likely we've been through 87. With 87, we might have some restatements, but we don't necessarily have to apply 100 to address that. But that is out there. So we do have a couple minutes, and we do have one question that came through. Is under GASB 96, Paul talked a lot about when it came to the software side of things. But also 96 deals with what happens though if you've got a contract that includes software, but also you are leasing the hardware. Now that causes an issue when 87 was issued. before and had a different implementation date, but now we're totally under 96. So how do you treat that hardware as a service? And what it is, it's going to be the same thing like with 87. You're going to take a look at the contract and determine from the, you're going to look at it from a software perspective and determine what's going to happen there. And then also the hardware side of things you're going to treat it also along the lines with 87, but you're going to have to look at the contract, determine the terms and all that. Paul, was there something else you wanted to add to that?
Nope, you nailed it. One of the things I pointed out is a lot of these contracts do have both components. And if the software is incidental or insignificant in comparison to the whole contrast, we're moving that over to the lease standard, and we're treating it like a tangible asset, and we'd have a right to use asset, just like any other lease.
Right. So, all right. So that's our portion of for today, and we will now go ahead and turn it over to the next section.
All right. Thank you, Paul and Lee. We are going to focus on unrelated business income for this next session today. My name is Deb Nelson. I'm a tax partner here at Eide Bailey and also lead our nonprofit industry. So on the tax side, my expertise is exclusively with exempt organizations. So unrelated business income is an area that I spend a significant amount of time. You think about exempt entities and oftentimes, people joke, well, they don't pay any tax. There's actually a lot of complex analysis that goes into whether or not an exempt entity will have tax liability. So for today, we are going to cover just a broad overview of what is unrelated business income. We are going to talk about the new regulations that came out back in 2017. They still feel new to me. And then we are going to identify some compliance requirements specific to alternative investments, and then wrap up with key considerations regarding those. So when we get into technical topics like unrelated business income, I think it's really helpful to first understand the purpose for those regulations. These rules were put in place to eliminate the unfair competition between exempt entities and the commercial sector. The two primary advantages that exempt entities would have without these regulations would be if they're not subject to any tax, they can charge less for potential goods and services that are unrelated to their purpose, which eventually could drive those competitors out of the market that are on the commercial side. And then the other one is they could also, grab your polling question here. The other advantage is exempt organizations could also then accumulate more capital, which would allow them for unfair advantage to expand their operations and once again, kind of overtake those doing similar things within the commercial sector. So that's where the background came for these unrelated business income rules. It really was to try and make a more even playing field between exempt and non-exempt entities. And to have unrelated business income, you have to have these three specific items. So a trade or business activity is going to be something that you're engaging in with the primary purpose to produce income or make a profit. And then to determine if that activity is regularly carried on, you look at not only the frequency that you're doing that activity, but you also compare it to those in the commercial sector that are doing a similar activity. And then the last criteria is to determine whether or not it's substantially related to your exempt purpose. So you have to have all three of these items for something to be considered unrelated business income. All right, so this is a small listing of activities that we commonly see create unrelated business income. By no means is this an all-inclusive list. And you can see we have advertising on here, selling merchandise that has no relation to your exempt purpose, the leasing space in debt financed buildings, again, earning income from activities open to the public. And we're going to focus our time today on the pass-through income from investments. So when a tax-exempt entity has ownership in a pass-through entity, that means that revenue is going to be flowing back to the exempt entity. And that's where we can start to have implications for UBI. The partnership income requires that exempt entity to look through to those underlying activities of the partnership. And then you have to essentially treat those activities as if you were conducting them yourself. That's that look through methodology. If you happen to have ownership in an S corporation, that is automatically going to be considered a trade or business activity. And absolutely all income, all gains from that are taxable. So S corporations are treated slightly different than other flow through or pass through entities. We are seeing most exempt organizations that are getting into investments that require analysis for unrelated business income, but also foreign reporting requirements. So we'll talk further about this as we get through more of these slides, but I would say pay particular attention to the K1 footnotes that you are getting from those investments. That is what we rely on most heavily for determining whether or not you have any UBI, state-sourced UBI, or foreign reporting implications. And as with all tax regulations, there of course have to be exclusions to the rules. So generally, we're going to say passive income is excluded from UBI. And so that would be your interest, your dividends, annuities, royalties. But then we also look at rent. Rent generally is excluded, but we break that down into components of what are you actually renting. So if your rent is coming from personal property that is less than 10%, you get to exclude all of that rental income from UBI. If there's a portion of that rent that's between 10 and 50% attributable to the personal property, then you have the ability to bifurcate that out. So you would only be picking up that personal property portion as taxable. And then if you're over the 50% threshold for personal property, then all rent is going to be taxable. You cannot exclude anything. So we oftentimes will see an opportunity here to potentially break things out into different contracts or different agreements if you have something specific to rent, to be able to take advantage of excluding as much as possible from tax. And then other exclusions include certain gains and losses from sale of property and income from research. And I do want to just make a quick caveat here that these exclusions do not apply to all exempt entities. For example, C7 organizations, investment income is taxable. There's certain rules for C9s, C17s. This is just some of the general exclusions. And then unrelated debt financed income also is an area that we tend to deal with a lot related to unrelated business income. So these debt financed rules can cause the passive income that we just spoke about to actually be pulled in as UBI subject to tax. So for debt financed property, that's going to be any type of property that you're holding, which you're holding to produce income or which you have debt on. And we look at these rules over the course of your tax period. So if there was property that you had debt on that's generating income, at any point in the year, we're going to have to pick up some taxable income for that. And if you have a tax period where you actually disposed of this property, then we look at the 12 months preceding that sale. So there likely still is going to be some impact for picking up taxable income. And when we talk about acquisition indebtedness, this is the outstanding amount of that principal debt that's incurred before, during, or after the acquisition or improvement. So as the taxable income, or what I should say is the taxable income is actually based on a ratio related to your acquisition indebtedness compared to the basis in that property. So as the debt goes down, your taxable income will correspondingly go down. And to further talk about this unrelated debt financed income leverage, leverage is going to be calculated again by looking at what that average acquisition indebtedness is. And for the average of this, we actually look at the monthly averages. So that would require, some additional detail to get to that. There are some cases where exempt entities don't have the monthly data. And in that case, we're going to be looking at the beginning and ending to come up with that average acquisition indebtedness. And then we take that over the adjusted basis of the property, and that is the ratio that's used in determining your unrelated debt financed income. So once we have that leverage ratio, you then apply that to the gross income, and that's going to be your taxable gross income. We apply that same ratio to the direct and indirect expenses. Those are your allowable deductions, and that's how you get to your net unrelated debt financed income. So again, as I explained, once that debt starts to go down, your ratio decreases, which means you're going to have overall less taxable income. Related to gains, again, general rule is most of these are going to be excluded from tax. However, there are exceptions in this area as well. Those are going to include the gains or losses from the debt financed property that we just discussed. If you have gains or losses from stock and property, that's considered inventory. Gains and losses from property that's held as sale to customers in the ordinary course of your business. And then there's kind of a unique carve out here for timber cutting. Now we're going to get into those new silo regulations. So the IRC section 512A6 was added to the tax code through the Tax Cuts and Jobs Act of 2017. And so these rules are applicable for tax years beginning after December 31st of 2017. They're commonly referred to as the siloing rules because they require you to calculate your unrelated business income separately for each trade or business activity. So prior to these siloing regulations, we had the ability to aggregate all unrelated activities and apply tax to that net unrelated business income amount. Now, under the silo regulations, you have to drill down and further define your activities by the type or trade or business activity it is. And then you're stuck either paying tax on that income or carrying forward losses. You can no longer aggregate amongst those activities. The final regulations were published, December 2020. And so they will apply to tax years beginning after that date. And for the tax years that were before that, we relied upon the proposed regulations. There were some slight modifications from proposed to the final regulations, but nothing I would say of great significance to really point your direction to. Within the final regulations, we now have the ability to use two-digit NAICS codes. And that's NAICS stands for the North American Industry Classification System. And when we're looking at those codes, that's where we would say, what is the trade or business activity that's being conducted? You go and find the NAICS code that applies to that, and that's how you're going to determine your silo for your activities. So for example, if you're invested in oil and gas, you're going to go to the NAICS codes and find the specific oil and gas code and drill down to the two-digit code. This is one area that there was a slight change in the proposed to the final. Proposed regulations actually said we needed to use six-digit codes, which made it much more narrower. Using that, we would have seen organizations have 3 times as many silos for unrelated business income because you had to go so narrow in how you classify those activities. So this was a really good change in the regulations where they said you can start using just the two-digit, which is a more broad category for how you're going to be bucketing that. And so the two-digit applies to any UB activities you're conducting directly, or if you have non-qualified partnership interests, we also would look to these codes to classify them. And then the IRS also requires separate silos for certain investing activities. And this is going to include payments from controlled entities, foreign corp insurance income, non-qualified S corporation interests. All of that is going to be bucketed under the investments. So for investing activities that can be aggregated, this slide kind of details out what those would be. It's a really nice provision within the regulations that they did carve out this investment silo, because so much of what we see in this area is through the investments. And if you have qualifying partnership interests, any partnerships that you're not controlling, if you have qualifying S Corp interests, and any debt financed property or income, all of that can be aggregated together under this investment silo. So this is a really key part of those provisions. So we're going to dig further into what are each of those investment items. So when we talk about a qualifying partnership interest, what do we mean? So this is going to be an interest where the exempt entity is not the managing member or the general partner. And this does allow us to aggregate that investment, assuming that we can meet either a de minimis test or a participation test. And once we have gone through this analysis and made the designation that this investment is a qualified partnership investment, that cannot be changed as you report unrelated business income, unless in the future you no longer meet those requirements. So it's really important that the analysis is done up front and that you document why or why not it is meeting the qualifying partnership interest. Then we also touched on qualifying S corporation interests. So this is going to be also grouped into the investment silo. Again, you have to meet the de minimis or the participation test. And under those 512A6 silo regulations, every S corporation is going to be treated as a separate unrelated trader business. So again, the S corporations, if you take away anything from today, just know that if you have an investment in an S corp, everything is treated differently. All right, so to meet the de minimis test, you can have no more than 2% of the profit interest or the capital interest. And I've got a little screen grab here that you'll be able to find this from the K1 information that you're obtaining. So if you look down in box J and you see the profit, loss, capital percentages, that's what we're talking about here when we're looking at whether or not you meet that de minimis under 2% test. Other key things related to this would be to ensure that you are listed as an exempt entity for the type of investor. Oftentimes when we've got multi-tiered partnerships that entities are invested in, it's those lower tiers that are actually generating the unrelated business income that flows up. And because of that being several layers down, it's really important that the investors know that they need to provide the adequate disclosures up to that top partnership for disclosure out to the exempt entity. Because as I mentioned earlier, we really rely on the footnote details within these K1s to make some of our determinations around unrelated business income, foreign reporting, and even state-sourced UBI. And the multi-tiered partnerships is what can make this whole investment process really complicated. So to talk about that de minimis example, grab your polling question number 5. I think it's easiest to understand how this works in those multi-tier partnerships if we walk through an example. So here at the top, you can see that we are invested in NFP Investment LLC. That investment is further invested in lower tiered partnerships. We're going to start by looking at the ones on the left-hand side. So to determine our interest in the Tier 1A LLC, we're going to take our 60% capital interest, multiply that by the 50% capital interest in Tier 1A, and that's going to give us a 30% capital interest in Tier 1A LLC. So that's step 1. Then we have to determine our interest in that next level, which would be Lux Apartments. We're going to take that 30% capital interest times the 10% capital interest in Lux Apartments, And that is going to tell us that we have a 3% capital interest in Lux Apartments. And Lux Apartments, as you can see, is noted as having debt financed income. So that is the level that's actually generating unrelated business income that will flow up to us. So even though we are over the 2% interest in that Lux apartment, because the UBI is considered to be debt financed, we can continue to aggregate that within our investment silo. We don't have to carve that out as a separate silo. So then let's take that a step further and look at the investment just to the right of that, which is the Car Wash LLC. So again, we take our 30% interest that we had in Tier 1A times our 6% capital interest in the car wash. That's going to give us 1.8%. That is below the 2%, which is that de minimis test. So if there were any UBI within that, we are also able to aggregate that within the investment silo. So then let's switch over and look at the other side of this with Tier 1B. Again, we take our 60% that we have in the NFP times the 3% capital interest in Tier 1B, and that gives us 1.8% capital interest. Since that is, again, below the 2% de minimis, we don't have to look any further in the Tier 1 lower levels. We can stop at that point and say everything can be aggregated. So as you can see, this is a multi-step process to actually analyze, can we treat unrelated business income as investment? Do we have to carve it out as a separate silo? There's a lot of work involved. It requires getting a lot of data, sometimes from some of these underlying partnership investments. I feel like it's getting better for what we're seeing coming through on this, but I have yet to run into one of these where we have not had to go back and ask for additional information. Okay, so to further talk about the participation test, we just talked about that de minimis test. Now we're on to participation. This is going to be able to be aggregated in that investment threshold if you hold no more than 20% of the capital interest and if you don't have control. So you'll see down below those kind of 4 bullet points on the end of this slide is where we define what control is. So the exempt entity can require the partnership to perform certain actions. If you have the power to appoint or remove any officers, employees, or directors, if you have the right to participate in the management of that partnership, or if you can conduct any of the partnership business, you're going to be deemed to have control within that partnership. So even if you were under 20%, if you have that control element, you're not going to meet the participation test. And that would mean you have to carve that out, treat it as its own separate silo. The silo regulations have changed how we calculate UBI for exempt entities. You know, I have mentioned that we have to look at those trade or business activities so that we can determine how to even categorize them for purposes of what's taxable and what's not. So some investments can meet the de minimis test. Some you may have that will be able to meet that participation test. And then we also have some that are just going to be investment because of the debt finance piece. Overall, this requires just a lot of tracking. I wish I said there was some magic spreadsheet, a trick to doing all of this, but it just requires time and attention to looking at each of your investments for these components. And under the silo rules, you know, if you generate a loss, let's say that we have something that doesn't meet the de minimis, it doesn't meet the participation test, and you've got to push it off to the side of it as its own silo. If that is generating a loss, you're going to be able to carry that forward, and it'll just keep carrying forward until that silo actually has taxable income that you can use that loss against. So again, you can no longer aggregate and take advantage of some activities that have losses to help reduce some of those that have taxable income. So alternative investments, I would say this is going to be probably the biggest area that we spend our time and attention on regarding unrelated business income with investments. So these are going to be your non-traditional types of investments. So we're not talking about cash or publicly traded securities or bonds. We are looking at investments that generally lack liquidity, oftentimes can be hard to exit, or there's a certain time period before you can exit these. And then the risks are also generally higher because of less regulation, more subjective valuations. Those are the types of investments that we're referring to here. So with the limited partnerships or LLC types of investments, you as an exempt entity should be receiving a K-1 for your allocation of that partnership activity. We can see these types of investments being both domestic and foreign. That is another really critical component in this UBI analysis, is first identifying what type of investment do we even have. So is this treated as a partnership? Is it treated as a corporation? And then getting an understanding of whether it's domestic or foreign. Oftentimes the K-1s will have detail that are going to provide us the information to know whether or not we have transfers to other entities. And again, if those transfers are going to be to foreign entities, that's where further analysis is going to come into play. It's not uncommon to see a single K-1 that generates multiple foreign filings related to those transfers. We're going to touch on those here in a moment. But I would say, typically looking at investment portfolios, not every single investment may be generating UBI, but those that are, I would say more often than not, it's not just UBI that you have to pay attention to. It's foreign reporting, and then it gets into the state-sourced UBI. And then when it comes to hedge funds, these are typically going to be structured as foreign corporations, and there's less detail that is provided. So the trick here is to even just identify if you have this in your investment portfolio, because you're not going to be getting a K-1 to alert you that I need to look at this. You have to make your best efforts to obtain information. Oftentimes, this is going to involve going back to your investment advisor to see if there's any additional tax reporting related to that hedge fund. And then the key thing to look at with your hedge funds is the transfers into investments. So generally, we're not going to see unrelated business income triggered by these types of investments, but it's going to be the foreign reporting that becomes really important. And, I guess word of caution here is investments sometimes can have very similar names, especially when we're talking about hedge funds and funds of funds. There might be just one little differentiating piece within the name of that investment, but there can be significant differences in how those investments are actually treated from a tax standpoint. So it's really important to make sure that you're working with your investment advisors and you know exactly which one you're invested in. So we generally analyze investments for two key components. As we've discussed, the unrelated business income is kind of step one. And that's where we're going to be looking at K-1 details for those pass-through or flow-through entities. We're going to want to make sure that there are adequate disclosures to help us make a final determination on whether or not there is UBI. Believe it or not, we still see K-1s that have items that generally would trigger UBI, and there's absolutely no disclosures. So gone are the days where you can just assume that you don't have UBI if it's not on there. You need to ask those clarifying questions and then document in your files. Most, I would say, again, a lot of the K-1s we're getting, the information is so much better than it was even 2-3 years ago. There's probably more information on those K-1 footnotes than you would ever want, but that's the type of detail that we need. And then that is going to be picked up and reportable on a Form 990T. For the foreign filing piece of it, here we're generally looking at transfers of property. You can also be triggered for foreign filing if you have over a certain threshold of ownership percentage. I would say that is much less common. It's generally going to be the transfers. And there are significant failures for, or significant penalties for failures to file. Generally, those are going to start at around 10,000 per form and can be capped up to 100,000. So again, should give you some motivation to spend some time and attention in this area. So for tax exempt partners, I wanted to highlight a few of those most common line items that we see that me and my team will look for when we're doing this analysis. So when you have a K1, first thing I look at is line 1. Do we have anything that's being reported here as ordinary business income? Generally, that's going to mean it's a trade or business and it's going to be unrelated business income. We also hone in on lines 2 and 3 for rental income. Towards the beginning here, I talked about kind of triggers for rental income. Generally, it's excluded, but if you have some personal property, or most often, if it's debt financed, that's going to trigger the unrelated business income. And then lines 5 through 9 is going to have your interest, your dividends, the royalties, other gains and losses. Again, we said generally those are excluded, but there's exclusions from that. So if you know that there's going to be debt financing, for example, if you're invested in a real estate partnership, those are generally highly leveraged. So almost all of the income that's flowing through on that is going to be unrelated business income, regardless if it's generally considered passive. And then line 11 is for other income. This, again, we would rely on additional footnote detail to determine what type of income this actually is that's flowing through to you, and then analyze whether or not it has to be picked up. So we do not simply rely upon, the data in the footnotes if there's reason to question the information there, or if it's absent and it doesn't state anything about unrelated business income. There also is a line 20 on the partnership K1 that can use a specific code to identify unrelated business income. And so this typically is going to be code V. And if you see that within the footnotes, that is going to relate to the unrelated business income. So the partnership is responsible for providing you this detail in order for you to do the analysis of what may be taxable. This comes in a variety of different formats. There is no prescribed certain methodology for how they must provide this. Grab your polling question 6. So as I mentioned, you can see this coming through as just a single coded amount under that 20V. You can see some really, really lengthy footnotes where you have to parse your way through to find what actually is applicable to you. There's just a variety of formats. So again, don't expect to see the same disclosure through all of your investments. And I thought we would just walk through what a couple of these disclosures look like. So this particular footnote disclosure is identifying the unrelated business income by calling out specific line items off of that Form K1 and saying this percentage of that amount is taxable to you. So it requires you to go through and do some math to actually get to what is your taxable UBI amount. And you will see some of those percentages are actually more than 100%. Again, not unusual, but this is a common way that we see the UBI identified. We also see very brief footnotes, such as this one, where it's again referencing that line 20V code and simply saying, here's your UBI from the pass-through entities and giving you a single amount. I would say we see less and less of those, but still see some coming through. This format is very common. Here you're going to see a footnote that provides columns of different information. So you have to make sure you're grabbing the right column that pertains to you. But that first one is identifying the unrelated business taxable income. And similar to the first example we looked at, this is going line by line through that Form K1, but instead of providing percentages, it's actually giving you the specific dollar amount. Oftentimes, they do not total this at the bottom of the footnote, so you're still having to go through and do some computation to actually add up the various amounts that are detailed here, but it is helpful that you have the amounts. And then lastly, if there is no unrelated business income, you want to see some type of footnote disclosure like this that specifically says, absent your own acquisition indebtedness, none of this should relate to unrelated business taxable income. And when they say absent your own acquisition indebtedness, that essentially means assuming you did not take out any debt to invest into this, nothing on that K1, it should be considered unrelated business income. So when you have K1 footnotes that are silent, they don't provide any of these types of disclosures, step one is to go back to that investment and request that information. So I talked a little bit about foreign reporting. We are seeing some really large engagements around foreign reporting compliance with pension entities, with other exempt organizations. It's just becoming a very common thing. So I wanted to go through what some of those forms are, what is triggering those forms to give you some things to look out for. So the most common form that I see is going to be the Form 926. And this is a return for transferring property to a foreign corporation. And the trigger for the 926 is we're looking for transfers of cash that are going to be more than 100,000, or we're looking for transfers of any other non-cash property with the exception of stock. There's a carve out that if you're transferring stock, we don't have to do a 926 reporting requirement on that. So here's where we would be looking at purchase information that you have for the investments, going back to your investment advisor. Oftentimes they will generate within your portal that you have access to. You can typically go in and pull down a report that will tell you, it will list all of the transfers to foreign corporations. So if you don't know that you have that, that would be a question to ask your investment advisor. We have oftentimes found many clients who did not realize they had the ability to go into the portal and actually pull down that type of report. So that can be really helpful as a starting point. The other form related to transfers is the 8865, which is looking at transfers to certain foreign partnerships. Not only is this looking at transfers, which has that same 100,000 threshold that we look at, but this one can also be triggered based on how much ownership you may have in a foreign partnership. So if you're over 10%, that will trigger this form. And based on what level of ownership you have in that foreign partnership, there will be more components of this 8865 that you're going to be required to fill out. But I typically will see it triggered more so for the transfers. And then the Form 5471 relates to ownership in foreign corporations. So that 8865 covered both for partnerships, the transfer and your ownership. When it comes to foreign corporations, there's two separate forms. The 5471 is specific to your ownership, where that 926, the first one on this slide, is only for the transfers. And again, for the ownership, we're looking at things that are going to be over 10%. And then once you're over that threshold, depending on where you actually are at, it's going to trigger a lot of different components to this form. It's a really, really lengthy form if you're having to fill it out for ownership. The 8621 is in regard to being a shareholder of a passive foreign investment company, or a PFIC. And we will see a lot of disclosures on K1s related to PFIC reporting. I mean, pages and pages and pages related to this. The only time that an exempt entity really needs to care about these disclosures is if that PFIC is generating unrelated business income. If that's the case, then we may have some filing requirements here. But I would say even with that, oftentimes we will look through those disclosures and you'll see some specific statements saying that the 8621 has been filed on your behalf. So really look through that. I know it can be a lot of information with those footnotes, but at the end of the day, we kind of need to identify why you are not subject to having to file that. And the 8886 is also a disclosure that comes through. This is related to reportable transactions. Commonly, the 988 loss is what we will see coming through on the K1s. There's certain thresholds where if you exceed that, then you have to file. Generally, it's going to be a very, very high threshold, with the exception of whether if you're a trust, that threshold is going to be less. So again, some of these reporting requirements are going to be based on whether you're a corporation or a trust for your own tax status. But something that you will commonly see. And then there's also FBAR reporting, or the foreign bank account reporting. And this is going to be related to any accounts where you have signature authority over foreign bank accounts. And if that value at any point during the year has gone over 10,000, then there's a form, it's the form 114, I believe, that has to get filed. So the other thing that we look at outside of the unrelated business income and outside of foreign reporting is going to be state reporting. I wish there was an easier way to do state reporting. It's probably one of the more time-intensive parts of this whole analysis because every state is different. It includes different filing deadlines, different tax rates, different thresholds for what actually triggers a filing or not. So all of this has to be looked at. And some investments will do withholding regarding the state portion of that, some will not. So you are going to maybe see some disclosures coming through where you're getting your federal K1, and then it's going to say, here's your state sourced UBI, and then you're going to find a bunch of state K1s after that. Those are important if your federal K1 is reporting unrelated business income. Again, this is an area that we are seeing better disclosures over the years. What I am liking the most, I guess, that's coming out is oftentimes the more sophisticated investments are going to include a page at the very end of your federal K1 that's going to list all of the states, and it's going to have the line items of the K1 revenue and expenses going across the top. And then at the very right, it's going to say your state sourced UBI total. So that's what we are really looking for to hone in on whether or not, there's anything that needs to be picked up at this level. If you are not seeing that type of detail and you do have federal UBI, that is something that you would want to go back to the investment and ask for the state sourced detail. And oftentimes, most clients are probably not filing in every single state that is generating state sourced UBI. And that comes down to a variety of reasons. One, it can be your risk appetite. So what are you willing to take on from that manner? The other one can be some of those variances that I discussed on, whether the state even taxes unrelated business income. There are a handful of states that don't. Some only tax if you have unrelated income over, say, $1,000. Some states also will look at pulling in the federal $1,000 exclusion. So again, a lot of analysis has to go into determining the state reporting piece of this. So for common compliance areas, overall, I just wanted to highlight again when that 990T is actually going to be triggered. So if you have unrelated business income from any silos that we have talked about, whether it's investment or other, if your gross income is more than $1,000 in any of those silos, that's going to trigger the 990T reporting requirement. Oftentimes we'll see exempt entities just look at their net UBI and say, oh, well, our investments generated 100,000 of UBI, but we actually have all of these losses from allocating investment management fees, some compensation. So at the end of the day, we don't have any UBI. We don't have a reporting requirement. That's actually incorrect. And you still should be reporting a 990T to show that gross revenue, show the expenses applied to now generate that loss. That is an important element, because if you're not filing the 990T to capture those losses, then in the event that you have a year that produces taxable income, you don't have the ability to go back and grab that loss to offset it with. Taxes due at the initial due date of the 990T filing. And this can again become a really complicated area when it comes to reporting, because oftentimes these alternative investments are not giving you the actual tax reporting documents until after that initial due date has already passed. So you don't even know whether you have unrelated business income. These are some questions to ask to investment advisors or your investment team when you're getting into some of these, is when can I expect that tax reporting to come back to me? Do these types of investments generally create unrelated business income? You know, should you be proactively paying any estimated taxes during the year to offset that? The timing can definitely impact your compliance. And then state income tax returns may be required, as we talked about. And again, those are going to possibly have different due dates than your federal return, may have some tax due. So trying to stay on top of that piece. And then the foreign filings. There's no specific extension that has to be done for any of those foreign forms that I talked about. Those are simply filed as attachments to your 990T filing. So I guess another word of caution here would be, you can have foreign filing requirements without having unrelated business income that generates that requirement to do the 990T. So be prepared that if you have a foreign filing requirement, the only way to file those forms is to attach them to a 0 990T. So it still may require you to actually extend that 990T filing so that you can transmit your foreign forms. So as you're thinking about your investing activities and the possible impact with unrelated business income, you know, it's important to keep in mind, you know, oftentimes we get the question, is this really worth it? I mean, there's a lot of compliance that we just talked about that can be created from these investments. And having UBI is not a bad thing. It just means you should be thinking about that overall rate of return, and you should grab your polling question number 7. Because if the rate of return on those investments is not offsetting the additional compliance burden related to the analysis that has to be done, then I think that begs the question, is it really worth it? And then it's important to be working with an investment team that is aware of these unrelated business income rules. There's never a more uncomfortable conversation than that with an exempt entity who had no idea they were subject to all of these requirements until we started doing this analysis. So make sure you're having these conversations and know what you're getting invested in. And I already touched on this third one, just having a sense of when you're going to be receiving these tax reporting documents, because that's going to play into your compliance requirements. And then one other consideration is you can invest through what's called blocker corporations. It gets its name because it essentially blocks that unrelated business income from flowing through to you as an exempt entity. You know, at the end of the day, it may not be any more cost effective than some of these other investments, because that blocker entity is still going to have its own tax reporting compliance, additional costs that can impact that overall rate of return. So overall, lots of considerations. I did leave a few minutes here. I think we've got about 4 minutes. If there are any questions that I can help address in this area. I have not been paying attention to the Q&A, so let me pull that up really quick. Okay, so we have a question. If a not-for-profit's mission and exempt purpose is to provide affordable housing, when that not-for-profit invests in a lower tier partnership that owns affordable housing, does UBI apply? Answer to this is it depends. It really comes down to the primary purpose for your investment in that partnership. If you're getting into that to further your exempt purpose, then there's potential that it would not be taxable income, but it's not an automatic yes. So you certainly, I think my contact information will be provided. If there are more specifics in that area, I'd be happy to chat on that. All right, do we have anything else in here? I see one regarding where a pension fund is our office building rental income UBI. Is there debt on that on your rental? I guess that would be my first question, because generally rental of space is going to be excluded from unrelated business income. However, if you have debt, that changes the picture. If that building is debt financed, and if you are renting out more than 15% of the space of that building, you likely will have unrelated business income. I see you're saying no debt. So assuming you're not providing any significant services in conjunction with that rental, if you're just doing, janitorial type services, that should be excluded.
Deb, it's Eric. There's one more question. Does UBI apply to pensions that invest in private equity? And you may want to, I know you touched upon it, throughout, but you may want to clarify. Thank you.
Yes, private equity is going to create unrelated business income possibilities that will need to be analyzed. Private equity is where we're seeing a lot of this tax compliance come into play.
The session that I'm going to talk to you about over the next hour is a review of the various secure acts passed by Congress. In many ways, this segment of the webinar is more operational for your plans than anything else. And so I'm giving you a break from debits, credits, and GASB, and I'll talk to you over the next few webinars on GASB, that's for sure. And I thank Paul and Lee for putting this together with Brad and the entire team for working on this. But we'll get back to GASB, as you know and love, over the May and especially June webinars. In terms of the Secure Acts, there are major reforms in some areas, which I'm going to review. And first, since anything prior to COVID, at least for me, is in a COVID fog, anything prior to 2020 in my mind almost doesn't exist anymore. It's time to do a quick review of the original Secure Act, and that was termed Secure 1.0, and that was passed back in 2019. And that'll give you a foundation for Secure 2.0, which was passed at the close of last year. And most of us were, taking a holiday break. And you may not have realized that it was passed, but I'm sure your general counsels, or at least somebody, running your program, probably has said, hey, wait a second, this is out there. We better, be cognizant of it. Yes, the law is entitled, the Federal Consolidated Appropriations Act of 2023, not 2022. But Congress, they're Congress. I'm sitting in Washington, D.C., so I see it every day. And you just have to laugh, when they title something 2023, and in reality, they passed it in 2022. There are many twists and turns in Secure 2.0, including some elements that are required while others are optional. So you really need to be cognizant of those. And dates are vitally important in some of the elements. And again, you really need to be aware of what is happening when, especially if you're in charge of your programmatic aspects of the plan. So again, watch, on the screen where it says mandatory versus optional. And again, watch the dates. And hopefully I'll have a few more moments at the end of my session for questions. But I know I'm the only one in between you and the cybersecurity session to follow, which is so important. So let's just get going. Okay, so what is Secure 1.0? Again, a refresher for you as it was passed in the dark ages prior to COVID. And for some of us, including me, quickly forgotten. The real name of that act, which was retitled, is the Setting Every Community Up for Retirement Enhancement Act. And, you know, I really wonder, in some of these, you know, federal laws, I just have to wonder if there's somebody in Congress who has the sole job of coming up with acronyms, you know, much like that, you know, someone in the drug company who comes up with the silly names for pharmaceuticals that makes no sense, but must have an X or a Q in them, which is really, really ridiculous, you know. And I'm sure there's somebody who has a full-time job, you know, that it comes up with, okay, the setting for every community up for retirement enhancement act. Gee, that must be secure, or vice versa. But in all seriousness, Secure 1.0 was the largest pension reform passed by Congress since 2006. And the bill itself is the product of a bipartisan effort to make retirement savings more accessible for less advantaged people. There are 29 provisions in the act, and you know, some of which, at least the more important ones, are on the screen. Now, Secure opens up restrictions on non-governmental multiple employer plans, which I'm not sure there are any on the webinar today. But what this entailed was allowing a single Form 5500 filing and audit for all employers that are part of such plans, which would be a significant savings. Now, in addition, if one employer fails in its responsibilities, the multiple employer plan as a whole would no longer fail. And that's known as the one bad apple rule. Or for those of you who happen to be Osmonds fans, you can start singing that song. You know, so it's one of my wife's favorites. So prior to Secure, the amount of elected deferrals for an automatic contribution arrangement into a 401k, it could not exceed 10% of compensation. And the Secure Act increased that amount to 15%, but no more than 10% in the first year that the participant was enrolled. Now, other safe harbors were increased within Secure 1.0 as well, including notices and other aspects. The other pieces of the Secure Act included creation of a new tax credit of up to $500 per year for employers to defray startup costs for a new 401k plan, and a simple IRA plan that included automatic enrollment. The credit was in addition to the plan's startup credit that was allowed under previous law and was available for 3 years. The credit also was there for employers that converted an existing plan to an automatic enrollment design. And in the former act, a small employer was defined as an employer with no more than 100 employees. And again, largely did not apply to many of our participants in the webinar today. The Secure Act required benefit statements to include an estimate of monthly income a participant could receive in retirement if a qualified joint and survivor annuity or a single life annuity were purchased. And these estimates, you know, were required at least annually, and regardless of whether any annuity distribution option is offered by your plan. Now, the Secure Act also directed the U.S. Department of Labor to issue safe harbor model disclosures. And it also specified assumptions that plans may rely on preparing these lifetime income disclosures and estimates. Now, these requirements did not take effect until 1 year after DOL had issued each of the interim final rules, the model disclosures, and specified assumptions. Now, finally, the Secure Act banned loans through credit cards, and these just became distributions. Now, there are other changes that began in Secure 1.0, including the expansion of the definition of compensation for grad students, which may have impacted your plan. And also before the Secure Act, the government required individuals with either a defined contribution or a defined benefit plan to begin taking distributions no later than April 1st of the year that they turn age 70 and a half. Now, the Secure Act raised that age to 72. Secure also allowed penalty-free withdrawals of up to $5,000 from plans for childbirth or adoption. And of course, Secure also relaxed the ability to contribute to IRAs, no matter what age, as long as somebody is working. Now, further, IRAs can now be, used to contribute to charities to the extent of the contributions into the IRAs. One thing that impacts individuals that are beneficiaries of IRAs, Secure has provisions requiring non-spouses to take distributions of the entire account of inherited IRAs within 10 years of the owner's passing for distributions made after January 1st of 2020. Now, this applies to both traditional and Roth IRAs. However, there are exceptions to this, especially for spouses, those who are disabled, minors, and a bunch of others. Before Secure, distributions were based on life expectancy. So before Secure, they basically figured out, okay, let's say you inherited an IRA. They figured out how long you're going to end up living, and that was your required minimum distribution. Now, of course, you could take more than that, but this was the required minimum. Now, starting with Secure 1.0, that was passed before COVID, that moved up to within 10 years of the owner's passing, as long as the distribution started after the Secure 1.0 or the person passed, after the Secure 1.0 was passed. Now, for defined contribution plans and 401ks, some of the IRA changes are mirrored. For 401ks, Secure 1.0 required that all part-time employees who've worked at least 500 hours for the past 3 year-to-date periods of their employment, they're required to be eligible to enroll in 401k plans in those workplaces that offer. Again, the workplace must have offered a 401k, and there's no requirement for a match. For other pension plans, such as defined benefit pension plans, money purchase plans, and hybrid plans, generally they're not allowed to permit distribution before the earlier of retirement, such as the termination of service or normal retirement age. However, since 2007, the law also permitted an employee to start receiving benefits while in service and before retirement, as long as that person reached age 62. The Secure Act reduced the earliest age that an employee can receive in-service retirement benefits from a pension plan from age 62 down to age 59 and a half. And that change was made for plan years beginning after December 31st of 2019. And there are many other changes, actually over a dozen of them in Secure 1.0. But that last one, adjusting the date from 62 down to 59 and a half. Now, it's somebody like me who is above age 60, that really didn't have any impact on it, on my own, planning for retirement. But for somebody who's getting, close to the edge there, you're getting above age 59 and a half, there's a change in planning that you may have to do because of Secure 1.0. But remember, we're talking about Secure 2.0. Now, this act has a massive scope of new provisions, 92 new provisions in total, and it includes significant changes designed to help close the existing gaps across the entirety of all retirement systems. Now, the bulk of the provisions relate to defined contribution plans, but there are several changes that impact defined benefit systems as well. In many cases, these provisions extend the reforms and initiatives started nearly 2 decades ago with the Pension Protection Act, as well as Secure 1.0. And there were some provisions in the CARES Act, which of course came out during COVID. Certain provisions reflect how competing financial responsibilities are interconnected with retirement savings. And they also offer new mechanisms to help in, managing your pressing financial needs within your retirement plan. So let's get to it a little bit. So in Secure 2.0, one thing that is for sure, there's lots of changes updating Secure 1.0 for individuals and employers. Now, again, as I mentioned at the top of the hour, some of these are mandatory and others are optional. And in some cases, plan amendments may need to be made to conform to Secure 2.0. And I'm sure your council is well aware of them. If changes are necessary, we have a few years to go until they're really required, but nearly all types of plans have some form of impact in Secure 2.0. And as the slides go on, I've tried to point out which is which, so just be aware. And there could be some variations, so just be aware that this is going on. One thing that has been seemingly overlooked by some is the impact of Secure 2.0 on 529 plans. And as a grandparent now funding 2 529 plans, it's like, that's the entirety of my working is funding my grandchildren's 529 plans. And I made my funding yesterday, actually. And as a grandparent, this is a massive change for my 2 grandsons. For distributions from 529s after December 31st of 23, Secure 2.0 is going to allow rollovers of certain amounts in 529 college savings accounts to a Roth IRA for the beneficiary. Now, rollovers are going to be limited to a lifetime limit of 35,000 and apply only to the contributions to the 529 account, including the earnings before the 5-year period ending on that rollover date. So you got to look 5 years prior, and you can take $35,000 and move them into a Roth IRA. Now the 529 account must have been open for at least 15 years. Now, this is great for my 2 grandsons if they decide that a 4-year college is not in the cards. Now, my oldest is just turning 4 next month, so he has a bit to go. But this is great if he decides, or if his younger brother decides that 4-year college, hey, it's not going to happen. Effectively, what you're going to do is 35,000 from each 529 can go into a Roth IRA to help them start saving, for retirement. Now, again, some of our grandchildren, they have some time, but effectively, when my oldest grandson turns 15, 35,000 can come out and start his retirement plan. Now, given that his tax bracket will hopefully be low at that time, it makes sense. However, the transfers must be first in, first out, not last in, first out. So there may be some tax involved, but talk to Deb Nelson or somebody like her, and they'll be more than happy to walk you through at that particular time, assuming the tax code doesn't change before then. Now, for those PERS plans that are well-funded and also have OPEB plans, Secure provides immediate ability to transfer a portion of excess pension assets to a pension plan's code section 401H account to be used for qualified retiree liabilities. That's, in other words, that's OPEB. Now, this was available prior to Secure 2.0, but it sunset on December 31st of 25. Now it's extended until 2032. Internal Revenue Code 420 transfers are available if excess pension assets, which are defined as the value of the assets over 125% of your funding target and target normal cost. If those are available, you can transfer some of that into an OPEB account. Now, Secure 2.0 allows a de minimis 420 Internal Revenue Code 420 transfer of 1.75% of the entirety of your pension assets based on a modified definition of excess pension assets. Now, how's that defined? So the code was updated to say that in each of the 2 years before transfer, the value of the assets more than 110% instead of 125%. So your plan must have hit its funding target, and not only hit its funding target, but be 110% of the funding target. You can transfer 1.75, not 175, 1.75% of that overage over into your OPEB plan. Now, this allows for dollar cost averaging, and but it does not apply for collectively bargained plans. What I'm going to do over the remainder of the hour is to focus mostly on governmental plan aspects and to try to delineate what is required and what is optional in Secure 2.0 as to the best of my ability. So let's start with required minimum distribution rules. And again, one of the more discussed changes in Secure 2.0 is the increase in the RMD age from 70 and a half to 72. And I don't know if anybody from France is on the line today. I don't see anybody from France, but they'd be upset at this, I'm sure. You know, we're increasing the required minimum distribution age from 70 and a half to 72. And now Secure 2.0 further increases the RMD age to age 73, starting on that started on January 1st of 23, and it's going to gradually creep up until 75 on January 1st of 2033 for distribution, and this applies to distributions made after December 31st of 22. And that's for individuals who turn 72 after that date. So this really would apply if you didn't take anything out of the pension plan, you know, and you turn 72 before December 31st of 22, but you hadn't taken anything out. Well, now you got to do it. And the distribution's pegged to somebody who was born coupled with the April 1st date of when somebody hits the RMD date. Now, your system may need to change. And again, this is only for the RMD. And not only will your systems need to change, but so will financial planning for the individual for retirement. Now I'm going to put on my individual hat. And in my case, since I'm eventually going to be a retiree of a defined benefit plan from my state, because some of you remember, I used to be a deputy state controller and I'm vested in my state system. So in my personal case, I now need to plan for RMDs beginning no later than age 75. But most of us are probably going to be, you know, start drawing down our 3 or 4% of the value prior to that. Now, notice the box. These will be on the remaining slides. And you know, I don't know if my pointer works or things like that, but they'll be on your right-hand side here. So just in case you miss it, keep an eye out as to how this is going to apply. Again, this is a mandatory change. Now, beginning after 2023, so we're starting on January 1st of 24, pre-death Roth required minimum distributions are not going to be required in employer-sponsored plans. And there'll be no need to roll over distributions to a non-governmental Roth IRA to avoid lifetime payments. Now, one thing that this may result in for certain 401 and 403 and 457 plans, you may land up seeing that participants may stay in plans for longer periods of time due to this sort of flexibility that's going to go on. And, you know, certainly I'm starting to get questions from some of my clients on this one on required minimum distributions. But certainly, you know, if indeed you have a provision in there that you have to transfer, to a non-governmental, Roth IRA, you may need to look at your provisions of your 457 and 403 just to see if it conforms to Secure 2.0. And again, this is not for every single plan, it's just for the ones on the screen. So an optional aspect on the RMDs, a surviving spouse may elect to be treated as the participant for the purposes of determining when RMDs must begin. For example, the determination using the surviving spouse age. Now, if the spouse dies, distributions at death would begin as if the spouse were the participant. Now, this aspect will be effective. I shouldn't say elective, will be effective beginning this upcoming January. Now, your plan can always keep the current timing and choose against this election as it's optional, but it really is how you want to deal with surviving spouses and the RMD. And so you may want to consider that based on your plan population. Now, one thing that's good for folks my age is the catch-up limits on 401s, 453s, and 457s. They are really increased after 2024. For me personally, it'll have no impact. But if I were turning 60 in 2025, this is a Jagunda deal. Until the change, catch-up contributions were currently permitted to be made to an applicable plan by participants who are or will be at least age 50 by the end of the calendar year, meaning by the end of 2023. And that's up to a maximum of $7,500 for 2023. And this is known as the age 50 catch-up limit. Now, once the change happens on January 1st of 25, so again, not 24, but on January 1st of 25, for eligible participants who are or will be age 60, 61, 62, or 63, but not age 64 or older by the end of the calendar year, the maximum catch-up contribution limit is going to be increased to the greater of $10,000 or 150% of the regular catch-up contribution limit of $7,500. So again, if you're turning 60, 61, 62, 63, on January 1st of 25, and you happen to have a little bit of extra change in your jar, you may want to take advantage of these updated limits because it will really make sense for you. And that's not a pun, but it will really make sense for you, or maybe should be, in your future retirement. Now, for those of us with 401ks, 403bs, and 457s, or simple IRAs, you may have started getting questions from young participants on student loan matches. Despite the cases that are winding through the courts, and the Supreme Court is only about 3 miles away from where I'm at right now, and I'm sure this is going to make it through and be tried in the Supreme Court. I know they've already had some arguments in it. Secure 2.0, it expands the ability for matching contributions into these plans, not just 401ks. And here's how it's going to work beginning on January 1st of next year. Employers will be able to match employees' student loan repayments, Now, Secure permits employers as an option to treat qualified student loan payments for qualified higher education expenses as elective deferrals and corresponding plan contributions as true matching contributions. Now, that's going to be subject to certain requirements. For example, payments subject to the elective deferral limit, all matching contributions should be eligible for the program, and the same rate for other elective deferrals and so on. Now, this is going to be kind of interesting because employers can rely on employee self-certification. You heard that right, self-certification of qualified student loan repayments, which for those in the accountability community, you probably are doing a heavy sigh right now. You know, for governments that offer these plans, this could be a way to increase plan participation for younger employees, but plan designs and operations may need to change. And again, there is that accountability aspect that I just sort of scratch my head, on that one. And, that whole self-certification from the employee, I go, how's that all going to work? Am I going to accept an email from the employee that hey, they paid however many thousand into their student loans, and then I'm supposed to match it into their 401k or 457 plan? I'm not sure how that's going to work, but again, this is an optional thing and you're not required to do it. But if you do want to do it and you want to make this employee benefit available, to your employees, think long and hard how this is all going to be. And I'm sure we can help you out helping to structure this. Now, there's tons of other stuff in the Secure 2.0 grab bag. Those who are not governments are going to be allowed to start employees off in a plan with a gift card, actually, as an incentive to join a 401 or 403B. Now, again, that's non-governmental employees because that kind of sounds like a bribe. These can't be paid with plan assets. For ERISA plans, there's an optional in-plan emergency savings account. And beginning in 2024, individual account plans can offer non-highly compensated employees an emergency savings account linked to their plan. Now, the contributions in those accounts are going to be capped at $2,500 or lower, and that's up to the employer. Contributions are made on a Roth after-tax basis, and they're treated as elective deferrals for purposes of matching contributions, and therefore matches are not made in the emergency savings account. Now, participants can be auto-enrolled at no more than 3% of their salary, and amounts must be able to be withdrawn at least once a month, and the first 4 withdrawals each year may not be subject to fees. Contributions must be invested in cash, interest-bearing deposits, and principal preservation accounts in these, emergency accounts. It also allows for certain penalty-free distributions for personal or family emergencies. And it allows, for example, 1 distribution per year of up to $1,000, but repayment must be available within 3 years. Now, once you do the emergency distribution, no further emergency distributions are permissible during the 3-year repayment period unless repayment occurs. Now, there was a mandatory expansion of automatic enrollment in 401ks and 403bs for new plans after that act was passed. The part-time worker coverage in Secure 1.0 was lowered to 2 years from 3 years to be eligible, and it expanded to ERISA 403b plans. Now, finally, there was an optional expansion of 403b plans to allow participation in collective investment trusts. Come on, there we go. All right, beginning on January 1st of 24 as an option, amounts transferred from a defined contribution plan to a default IRA for the benefit of an individual may be automatically transferred into the retirement plan of the individual's new employer. Now, the individual must be an active participant in the new employer's plan. They have to be given notice and an opportunity to elect to not have the amount automatically rolled over. And the providers must satisfy certain conditions, such as acknowledgement of fiduciary status. If the plan desires to do this, it may require a plan amendment and agreements with providers. This may need communication to all of your participants, and this is effective at the end of this year. Now, I can remember way back 13 years ago when I left state service, taking out my 457, it was a real challenge, and moving it over to my new employer, which was before I went to Eide Bailey, it was a real challenge, and it took about a month to do it and file all the paperwork. So hopefully these changes in Secure 2.0 will streamline things a little bit. Okay, there are tons of provisions in Secure 2.0 for our first responders. And, you know, this is a good thing. My nephew is a first responder. He's an EMT in Pittsburgh, in addition to owning actually a great bar. He's an EMT. And so I keep saying to him, his birthday was yesterday. And I say, he turned 40 yesterday. And I said, Jay, are you drinking the profits yet? And he started laughing. And he says, you know, Eric, as an EMT, sometimes you do have to drink the profits after stuff that we see. But this is a good thing, is Secure 2.0. You know, prior to Secure 2.0, a retiree's disability benefit that is excluded from income under IRC 104A, under a statute in the nature of workers' compensation, they lost its tax exemption once that you know, EMT or for other first responder lost, you know, once they hit normal retirement age. You know, if the disability benefit, you know, then would convert to a normal retirement benefit. Under Secure 2.0, again, just for first responders, the service-connected disability benefit under a pension or annuity retains its tax exemption, even though the benefit converts over to a normal retirement benefit. Now, this is a mandatory change for 401As, defined benefit, defined contribution plans, 403Bs, and 457s. And it is effective for plan years beginning after December 31st to 26, though. So we have some time to make systems changes, but this is a big change for a lot of our participants in our plans, because we know we have firefighters, police, EMTs, and you name it. You know, they're participants in our plans. And the fact that you're now going to a tax exempt service connected disability, basically, even when you hit the normal retirement age, that's a big change. That's going to go on. So we have some time to make our plan changes, but we probably got to get paperwork in order. Now, for other distributions, Secure 2.0 allows defined contribution plan sponsors to allow withdrawals while still employed, but only for specific reasons that are on the screen. Now, these distributions are exempt from the 10% early withdrawal penalty tax. And in most cases, the participants have the opportunity to repay the distribution and even receive a refund on taxes previously paid on the distribution, as long as the timing requirements are met. Even if a plan does not allow an optional distribution, if a participant who is otherwise eligible for a distribution receives a distribution that qualifies under one of the provisions, the participant may treat the distribution as qualifying for a favorable tax treatment when completing their tax return. And now the slides that I'm going to show you over the next few minutes, they detail some of those changes. So you may want to bookmark them, but here is the summary slide. And again, you may want to circle these if you happen to have one of those tablets that you can write on and things like that and save the PDFs. You know, you may want to circle these, because there's going to be a situation where, you know, you're going to have some non-public safety employee that is going to have at least one of these during their employment with you. And especially, of course, births and adoptions, you know, personal and family, emergencies. Some of us where, we have disaster areas going on, and so there's going to be, some of these changes out there that you're going to get a question. Hey, can I get a loan out of my plan? And would it be subject to the early withdrawal penalty, even though I'm under age 59 and a half? So just make sure you have at least this in front of you. So let's go through each of these. Now, beginning next year, as an option, one emergency withdrawal of $1,000 can be made from 401A defined contribution plans, 401Ks, 403Bs, and 457Bs for family emergencies. And again, it can be repaid. And for those of you out there who have money purchase plans, you can't do this one, but you can make the distributions from other types of plans. And again, we're talking 401As, at least on the defined contribution side, 401Ks, 403Bs, and 457Bs. Now, births and adoptions can be funded by withdrawals as long as they're repaid within 3 years. And I happen to, you know, again, being a granddad of a 4-month-old now, you know, my daughter really was considering doing this, but they decided, you know, we don't need a distribution. And so, you know, this is a really good thing. And again, as long as it's repaid within 3 years, it is tax-free. Now, if someone unfortunately is a victim of domestic abuse, beginning next year, they can withdraw $10,000 or 50% of all your accrued benefits from a defined contribution plan over a 1-year period from the date of the occurrence. Now, this can be made from a 401k, certain 401as, 403bs, 457s, and IRAs. Now, again, this is beginning next year, and that's why it says January 1st of 24. There's a relief of the 10% early withdrawal penalty from someone who unfortunately is terminally ill from most plans. And this change was made immediately. And you got to submit some sufficient proof to the plan from a doctor that you're expected to unfortunately pass within the next 7 years. You know, and again, this is to alleviate the 10% early withdrawal penalty if that terminally ill individual is under age 59 and a half. So Secure 2.0 defines a terminally ill individual as an individual who's been certified by a physician as having an illness or a physical condition, again, that can be reasonably expected to result in death in 84 months or less after the date of certification. Now, what's going to happen is the employee must furnish sufficient proof to you as a plan administrator that the employee qualifies under the standard. And now the provision does not create a new distribution right under a retirement plan, so a participant would need to be eligible for a distribution under an existing rule. So again, they're vested, whatever the rules are for your plan provisions, but they've come to you and say, hey, I got some bad news. Hey, can I get a distribution? And they provide this certification to you, and you have to, you know, say to yourself, is that sufficient proof? And chances are it is. And again, it won't be subject to the 10% tax penalty if they're under age 59 and a half. Now, it can be repaid within 3 years, but, you know, chances are, well, let's just leave it at that. A retirement plan or an IRA may permit as an option a qualified disaster recovery distribution of up to $22,000 if made within 180 days after the first day of the incident period applicable to a qualified disaster, if the individual's principal place of residence is within the disaster area and the individual has sustained significant economic loss due to the disaster. Now, the plan may rely on the individual certification that the distribution qualifies under the standard, but in many cases for the folks on the webinar, it's pretty self-evident, especially if you're down south over the past couple of weeks. An amount distributed on this basis is not eligible for rollover. In addition, the distribution is not going to be subject to that 10% early withdrawal penalty tax. Is taxed over 3 years, and it can be repaid within the 3 years. Now, the provision also permits an increase in loans, a delayed repayment of loans during the 180-day period following the day of the incident. Now, this one's interesting because it was backdated to January 26 of 2021. So think about that. Okay, so if there was a disaster in your area, somebody's going to be coming to you and saying, hey, can I take a withdrawal of $22,000 from my account, and not be subject to penalty as long as I repay it within 3 years. And again, it's backdated to January 26 of 21. For 401ks, DC plans, 403Bs, and 457Bs, Secure 2.0 permits plans to allow for a distribution of up to the lesser of $2,500, which will be indexed in future years, or 10% of the present value of the participant's vested account accrued benefit under the plan per year to pay for premiums for certain long-term care insurance contracts for the employee or the employee's spouse or other family member. That, the distributions are not subject to the 10% early withdrawal penalty tax, and they're not eligible for rollover. And certain reporting requirements will apply. Now for long-term care contracts, this is going to start after December 30th of 2025. And again, this is only for defined contribution plans only, but this is a pretty big deal. Again, for public safety officers prior to Secure 2.0, the 10% early withdrawal penalty did not apply to distributions that are made to an employee who separates from service after age 55. This age is now reduced to 50 for qualified public safety officers with respect to distributions from a governmental plan. Secure 2.0 expands this exception to apply to distributions made to qualified public safety officers who separate from service after the earlier of age 50 or 25 years under the plan. Now, in addition, Secure 2.0 expands the definition of a qualified public safety officer to include corrections officers and forensic security employees. Now, this is mandatory and it was immediately impacted, but no plan action is required. But system changes may be needed in your accounting systems, and there might be some plan provisions you may need to adjust. Now, there's also included a section in Secure 2.0 for private sector firefighters. So for example, again, I'm in Washington, D.C., and right up the road from me is Chevy Chase, Maryland. And there are certain areas of Chevy Chase, Maryland that have their own firefighters. So it's a private system, even though they're part of the city of Bethesda, Maryland. They have their own private firefighters, and they're not in that city limit. They're actually technically under Maryland law. They're called villages. And so that would apply to those firefighters. And again, it's all in Secure 2.0. All right. Now for 457Bs, there's going to be simplified rules. Prior to Secure 2.0, a plan sponsor cannot generally force out distributions to terminated participants if their account balance, exceeded $5,000. Secure 2.0 increased the force out limit to $7,000, and distributions exceeding $1,000 are still required to be rolled over to an IRA if the participant does not consent to receive the distribution in cash. And this provision is effective for distributions starting next year. Now, for 457Bs, prior to Secure 2.0, a plan participant was required to enter into a reduction agreement to defer comp to the plan and before the beginning of the month to which the agreement applied. And this was a real difference between 401ks and 403Bs, where a participant can begin contributions as soon as the administrative paperwork is done and after entering into a salary reduction agreement. Now, Secure 2.0, it aligned the rules for 457Bs to those of 401ks so that contributions can be made effective for any compensation made to the participant after the agreement is signed. So let's say you sign the agreement on Thursday, but your first salary reduction is Friday, you're immediately in the 457. Now, note that participants of tax-exempt 457 plans are still going to be subject to the first day of the month requirement. So in those cases, you're probably at May 1st if you elected today. Plan sponsors may need to amend their governmental 457B plans to allow this change. And if they make the change, the plans are drafted to satisfy the current rule, which began immediately. Now, for public safety officers, as an option, up to $3,000 of distributions from a governmental retirement plan to a public safety officer to pay for health insurance premiums, that'll be excluded from gross income as long as the plan directly pays the insurance company. And that's a really cool benefit. And that'll really help out public safety officers' taxes. Secure 2.0 repeals the direct payment requirement and allows payments to the employee. And again, this is a major change in the area, but again, it has to be made to an insurance carrier at some point. Okay, so on January 1st of next year, a mandatory change was made by Secure 2.0. A 401k, a 403b, or a 457 may permit participants who are age 50 or older during the calendar year to do those catch-up contributions. Now, under current law, catch-up contributions are made either on a pre-tax basis or after-tax Roth basis if allowed by the employer. Now, Secure 2.0 catches up contributions to be made on a Roth basis from all participants whose wages, as defined by the Social Security Act, from the employer sponsoring the plan exceed $145,000. Now, that $145,000 is indexed after 2024 for the preceding calendar year. And participants with wages below $145,000 for the calendar year must be given an option, but are not required to match those catch-up contributions on a Roth basis. Now, as you'll see over the next few minutes, the dates really mean a lot. The changes were made effective on sliding dates, with some changes resulting in an immediate impact while others delayed until December 31st, 27. For most of us on the call, the mandatory changes should already be in process. And the optional changes, well, you're going to need some discussion, but we have a few years to figure it out. In general, there's a relaxation for contributions to plans for higher rate wage earners, especially after 24. For longer-term part-time employees, there's also a general relaxation of participation into the plans. And again, for younger plans that are out there with student loans, the matching contributions from employers as an option, that's a powerful tool to retain employees, as long as you understand the provisions of those student loans and that certification business as to whether or not you're okay with receiving those contributions, those certifications. There are provisions for emergency savings accounts, which for many of us are really important. Remember that piggy bank that's out there. And then there are distribution changes, some of which have relaxed taxation depending on facts and circumstances. Now, with that, again, that's a pretty quick, overview of Secure, 2.0. Let me take a look and see what I got in a question here. I got one here. Now, this is a pretty good one. If an employee works for a governmental office, for example, 22 years, and then goes to work for public safety as a public safety officer after 3 years, is the employee eligible since they have 25 years of total service? I think, yeah, I really do. And when I was a deputy state controller, it was really prevalent that folks, after a certain amount of years, they really looked to those public safety administrative jobs to see if they could retire early. And that could be one of those situations where, you could easily jump over into the public safety side, maybe do some forensic work or things like that. And sure enough, that could be, but I would really defer to your general counsel, because your plan provisions really need to be taken a look at. Ask your general counsel how you think those would apply. But I really think Yeah, if you have some employees that are going to jump over into the public safety realm, you could have a situation where folks are retiring a lot earlier than you think. So with that, let's see, are there any others in the chat? Let me just see. I think I got one here. No, I guess not. Let's see, do I got any others in the questions? I do not. Okay, with that, everybody, at least for me, please have a great holiday weekend, a happy, healthy, and safe holiday weekend. And certainly, for those of you in the storm zone, of which we are here in the East Coast, stay safe out there. It's raining pretty hard here in DC. And so with that, I want to turn it back over to Maya, who's going to turn it over to Chris.
Thank you very much. Well, welcome everybody. I'm going to go ahead and pull up my slide deck here. So today we are talking about cybersecurity best practices, and I want to pose a question for you here, or a situation. Everybody's received those phone calls, right? Hey, your vehicle maintenance warranty has expired. You want a timeshare. One of my friends, a couple months back, reached out to me. She said, "Hey, Chris, I just received a very disturbing phone call." What had happened was she had a phone call come through and she heard a girl screaming in the background, just screaming, "Mom, mom." And then a person came on the line and said, "Hey, we have your daughter." They knew her name. They said, we have so-and-so. You need to go to one of these stores and buy $10,000 in gift cards and mail it to this address. She was out driving. She happened to be next to a police station. She went into the police station and they said, "Hey, this is a scam." They had kept that on hold. She gave her daughter's phone number. They called the daughter. The daughter was fine. Now, what's the purpose of that? We'll explore that as we move on here. Like they said, my name is Chris Williams. I am a cybersecurity associate here at Eide Bailey, and I really want to walk through just some of the risks that we're facing as individuals as we really look at trying to figure out how does this work. As we look at all of this, what we really want to focus on is what are today's threats? What makes you individually a target? We're not really looking as much as at the organization that you work for, but what does it mean for you to be the target? What are the risks that we're facing, and what can we do to really protect ourselves and help educate those that we really care about as well? Because if somebody else around you happens to be affected by this, somebody that has your information as well, then you're a target as well. So what can we do to really start thinking a little bit more secure? So as we look at this, one of the things that we want to focus on is this idea that, hey, what are the myths that we see in the cybersecurity industry that other people have bought into? A lot of it is, hey, even if they hack my accounts or whatever, it's not that big of a deal. It's not going to bother me. I don't have anything that they want. There's no reason for them to attack me. The biggest one that I see a lot of times is, hey, phishing scams are super easy to spot. I'm not going to get caught by this. Almost every person I've talked to who's fallen victim to a phishing scam, they look at it and they're like, "Man, I feel so stupid. I must get 100 of these a day. I've never clicked on one, and they got me when I was busy or I just wasn't paying attention." It's always this idea of, well, I did it right 99 times. I messed up that one time out of 100. And so that's really what they're looking at here. And then the last part is, or another part that we're seeing is that it's not really my responsibility. My organization, my firewall, whatever it happens to be, I have all these different protections in place. So I should be safe, right? You're going to have that yellow bar come across your email or something that says, "Hey, this is an external email," or "This is a spam call on your phone." What we're thinking is we have all of these different things to protect us so we can lessen our responsibility. What we really need to look at is, well, why are these attackers coming after us? What is the point of it? And why is it such a big deal? So what we see in the industry these days these are some of just the headlines from the last 3-6 months. Just today, the FBI seized a hacker's website, had over 116 countries, and it held over 80 million credentials. And these are credentials to log into bank accounts, social media accounts, email accounts. And oftentimes they were combined with things like the security questions, fingerprint IDs, all of that really pertinent information on trying to pretend I'm somebody else that I'm not supposed to be, or get information that I shouldn't have. Now, as we're looking at all of these different things, these are all companies, but most of the time, what we're seeing is that the initial entry point was either through a phishing attack or a vishing attack. So either somebody sent out an email saying, hey, I need you to click on this link, or I need you to open this document, or they made a phone call and they got some credentials that way, or they're just getting some information. So what we really want to see is, well, how are they getting through? What are they doing? And what kind of information are they gathering that puts us at risk? A study done by Dr. Daryl Van Tongeren, where he does this every year. And what he does is he says, all right, well, how would you rank yourself in general compared to the rest of the class or the rest of the student body to all of these different topics? And every year, the students come back and everybody votes and rates themselves either average or above average. It's this idea that, all right, well, I'm just as good, if not better, than everybody, all of my peers around me. Now, the problem is if you think back to your college days or your high school days, think about the bell curve. And the part of that bell curve is you have to have a pretty even distribution across that bell curve, right? So we have people that are messing up the curve. You know, if the teacher's grading on curve and they score 100%, it's like, oh, well, now we don't get a curve. Well, you also have the people on the other end of the bell curve that are below average. Now, most everybody is going to sit right in that meaty part of that average. Now, when we look at this and we look at our ability to spot a scam, this falls into that same mentality of, oh, I'm better than average, or I'm just a little bit at average, right? Everybody thinks that they're gonna do better than everybody else around them. Now, if that was the case, then why would we have so many phishing scams being the number one attack from the bad guys year after year after year? The reason being is that everybody thinks they're going to spot it, but the problem is that they're still getting through because people aren't spotting them. So even if you think yourself as above average or at average, the bad guys say, all right, well, I'm not worrying about the average because obviously people are still clicking on these. So when we look at this, we really need to focus on this idea of the bad guys don't care what we think we are. They're changing up their tactics to make it more and more believable. One of the things that I like to do when I'm doing different tests on organizations, whether that be through phishing or vishing, so I'm making those phone calls or I'm sending out that email, is I really want to make sure that I make it as during their busy time as possible. If most of you are like myself, just have a ton of emails come through, right? And so you think, all right, well, I can get through this. So either they're hopping onto a current thread of an email so that they've already attacked and gotten into the surface and are just trying to get better privileges, because let's say you're in a certain department that has this information that's really pertinent to me, but I see that you've already emailed somebody else in your organization. Well, I'm going to hack their email first, and then I'm going to get to you to help have you download some of these packets so that now I can get into your information. Or my favorite way to get in is to just call somebody. I'll look at LinkedIn and find out who the IT director is, who the CIO or the CISO is. And what I'm going to do is I'm going to call and say, hey, I'm always Mike from IT. That's who my guy is. So if we end up doing a phishing call, you'll know, hey, this is Mike from IT. You should have gotten an email from so-and-so. We're doing some network updates. I just need to get some information off your computer. Now, there's no email coming out from the CIO or the CFO, but if you're as busy as most people, you haven't had time to look at that. So if you're not on your game and you're busy already and you just need to get through this phone call so you can get back to work, you might just give me that information. And a lot of the times that works for me. So when we look at our next slide here, what are we seeing as far as trends go? What's the big push right now? The biggest thing, as I was talking about before, is this idea of the attack sophistication. Right there in the middle. So what we're looking at is we're no longer seeing, or we don't see as often, we still see it, that Nigerian prince or the Ethiopian prince that says, hey, I just need you to send me some money because my funds are tied up. That has been around for years and years and years before internet, before email. But that was a common scam. Everybody kind of jokes around. I gave the example earlier of those phone calls that say, hey, your vehicle warranty is expired. The big one now that we're seeing is hey, your Amazon Prime account has been suspended, click here. Your iTunes account has a charge. You have a FedEx delivery. But what we're seeing is that's a lot of the ways that people are getting in. Now, the next thing that we also see is that there's a lot more things coming on our network. When we look at what happened with the pandemic, almost everybody got sent home that was able to be sent home, and they were working from home. And what we're seeing now is that we have a lot more devices on our network. We have a lot more data that we're not seeing and that we're in control of that are now going into people's homes on unsecured Wi-Fi connections, and things like that, where the bad guys are now saying, oh, well, if they're sending all of this data home and you have a Wi-Fi router at your house, I'm going to drive around your neighborhood, which is what they used to do, is drive around businesses. I'm going to drive around your neighborhood and see if I can't find some Wi-Fi signals. Now, what I'm looking for when I'm doing that are things like Netgear or Comcast or whatever it happens to be. If you haven't renamed your Wi-Fi router, there's a good chance that I'm going to be able to find your Wi-Fi password, or I'm going to be able to just crack it. Now, once I'm on your Wi-Fi, that gives me a lot of leverage to figure out, well, what else is on here? I'm assuming that most everybody on here is some form of accountant, just based on all of the topics that we've gone on. But most of you guys are nice and organized, especially when it comes to your own taxes. Now, let's say I get onto your your computer, and I'm looking through your file shares. What's the likelihood that I'm going to find taxes 2003, taxes 2002? And what kind of information is that I'm going to be able to get? So what we're looking at is the ability for me to start getting onto your network. Now, let's say you have a secure Wi-Fi. What we're also looking at is we're seeing the growth of the attack surface because of the Internet of Things. So when we look at what is an Internet of Thing device, well, how many of you have a smart device at your house that you can talk into, or you have smart lighting, or you have a smart thermostat or a Ring doorbell? Any of those sort of things have security issues. They've been hacked. Ring recently, just last month, suffered a major data breach. So it's one of those things. What we're seeing is all of these things make it really difficult for cybersecurity professionals to secure technically all of the different technical controls that are on the environment. So what we really need to rely on is the ability for our employees, our coworkers, our friends, our family to really start thinking, oh, this might not be what I think it is. We need to really take a deeper dive and to figure out, well, why are they asking me these questions? What are they looking at here? And so as we move forward, the idea is that they're only looking for that one time for you to mess up. My mother-in-law got hacked a few months ago, and she said the exact same thing I was saying before. It's like, I just feel so stupid. I never have this happen. I got an email from her right after it happened. It was from her saying, hey, I need some help. Can you take a look at this? And it was a file. I called her immediately, said, hey, Benita, you need to shut down your email. You've been hacked. And she's like, what? And it was her only email. She was getting ready to go on a trip to Italy. She had credit card information going across the streams, and all of her friends got the same email. Now, it was one of those things where she thought Yahoo was asking her to upgrade her service. And so she clicked on it thinking, all right, well, I keep getting these things from Yahoo. I keep pushing it off. I'm going to go ahead and upgrade my email so that it's good to go. She didn't take the time to think, all right, well, do I need to research why Yahoo's asking me to upgrade my email service or my browser, whatever it happened to be? She didn't. She just put in her credentials and then she was locked out of her account. It was one of those things. What we're seeing is people are going through those kind of attacks fairly often, where it's just they're pretending to be one of your service providers. So whether that be your Googles or your Amazons, your PayPal account, those sort of things, criminals are looking at that. Now, the biggest takeaway from that is the idea that even if it wasn't your personal account that's being attacked, if somebody that you care about is being attacked, now they have access to your email. Now let's pretend my mother-in-law didn't know that all of those emails went out, or I wasn't paying attention. I just see an email from my mother-in-law saying, hey, check out this picture that I took of your daughter, or whatever it happens to be. I might actually click on that, because the bad guys now are looking at the emails before they're sending out this random phishing email to try to make it more tailored to really get you. Now, what we need to understand then is, well, how are they getting all this information? What are they doing? So the first thing that we do as the good guys, when we go through and we pretend to be the bad guys, is the same thing that the bad guys are doing. I'm going to do a ton of research. Now, we're depending on the amount of research I need to do is just depending on how much money I think I'm going to make as a bad guy. Or as a good guy, it just really depends on how much time I have. Now, there's all kinds of computer programs out there that I can use, that the bad guys use. I use the same computer programs the bad guys do to start scanning different things. What am I going to scan? Well, I'm going to scan your social media profile. That's first and foremost. 90% of the time, that's the first thing I'm going to look at. For most of you, you're like, well, what's that look like? What am I looking for? Well, I'm looking at your Facebook. I'm looking at everybody who your friend is on Facebook. I'm especially looking for people with the same last name as you on your Facebook account. Now, let's say, hey, Chris, I don't have a Facebook account. I don't post on that. Most everybody's also going to have a LinkedIn account. So I'm going to look at that. Well, where are you connected to? What organizations? What are your previous jobs? Now that I have some of that information, I'm going to start looking out from there. Who on that has more information out there? Now, all of this can also be automated. I have all kinds of programs that run Python that can say, all right, well, I'm just going to scrape this username, this person's name to find as much information as I can. Now, for those of you that haven't Googled yourself, if you have a unique name, you're also one of my first targets because it's really easy to Google unique names. For myself, it's unfortunate for people that like to Google themselves. Chris Williams is a really common name. I'm really hard to find. I know how to find myself. If you look at me, you could probably find it eventually. But for those of you with unique names, I'm going to find you pretty much instantaneously. And on top of that, I'm going to be able to find things like your phone number. And then I can put your information into my scraper, and I'm going to find all your social media accounts. Now, if you don't have certain social media accounts, if I was a bad guy, I might just open some of your social media accounts for you and start actually moving out and trying to connect with some of your friends as you. So I can start getting some more information that way. So what can I build up? Now, once I have all of that, I'm really going to figure out, well, what can I do to take advantage of all of this information I have? Let's pretend I'm just a normal everyday bad guy. I'm sitting in front of your house. I'm waiting around Christmas time or around a holiday and seeing your timers go on and off. Think about Home Alone, the movie with Macaulay Culkin years ago. I'm Joe Pesci. I'm sitting out. I'm saying, all right, well, so you guys are all going to France? All right, well, I know what time you're leaving. So now you're open. So as a bad guy, I'm looking at all of this. I'm saying, all right, well, these are the areas that this person might be vulnerable. So now I'm going to start figuring out, well, what can I do to attack that? Now, once I'm in, I might not explain or declare, hey, I've got all your information. I might just sit there for a while. In fact, that's what bad guys are doing is they're sitting in the infrastructure. They're sitting in all of our different data systems for about 287 days. What are they doing? They're trying to figure out, well, how's your information flowing? What kind of information are you sending out? Where are you storing your backups? What can I do to make it so when we get to that point of saying, I have your data, you have nothing you can do. They're also trying to figure out, well, how much can I actually ask this person? How much can I force them to give me without putting them out of business? What's a reasonable number? If I look at it and I'm like, well, I want $1 billion. You laugh, well, pound sand. You can have my information for $1 billion. Well, I look at it and I say, all right, well, I've seen paychecks come in. I've seen how much they're spending on groceries or out to eat. This is expendable income for them. There's a number that we can put into this formula and say, all right, well, this is how much they're going to be willing to pay. Because ultimately, all of this work and all the stuff that they're doing is so that they can get money. The ransomware industry was a $3 billion industry last year. So there's a lot of money that can be made from different individuals, different organizations, because people want their data back. They want information that's really important to them. One of the things that hit home for me when my youngest was born is we lost one of my computers, or we thought we lost one of my computers that had all of the videos and camera photos and all that stuff from when my daughter was born. And so it's like, oh, well, how much would that information be worth to me? And so what we're seeing is, well, now that they're in our system, they're going to do something with our data. They're going to do something, whether that be to use it to get to somebody else that has more money, and they're just still going to sit in our information. They're going to turn our computer into a zombie and use it to attack other computers, or they're just going to take that data and tell us, hey, you owe me $20,000. You owe me $10,000. Because ultimately, what we're seeing now is that bad guys have complete organizational structures where they not only have the people that are doing all of the bad things and hacking into your computer, but they have sales departments, they have executive leadership, they have accounting, they have marketing, and they have recruiting. Just like anybody else, Conti ransomware group out of Russia had their org chart released earlier this year, and we saw that they have all of these different infrastructures in place to help push this idea of making money. Now, when we look at things, this is one of the older slides that we used to say, all right, well, this is how we can tell immediately if it's a phishing email. And these are all the different things that we're looking at. Now, a lot of these things still apply. The biggest one that you need to pay attention to is anytime there's a hyperlink or there's an attachment, you need to pay attention to what's going on there. The FBI released a warning saying, hey, if you didn't ask for something, don't open it. So if you get a random package in the mail, you get a random text message, you get a random email that has some kind of attachment, don't open it without verifying that this is actually something I was asking for. If all of a sudden a coworker says, hey, can you check this file out? Check in with that coworker. Give them a call on over the phone, send them a message over Teams, some secure way. Don't respond to that email. Hey, did you send this to me? Because if their email was hacked or if their email was compromised, now you're just opening an attachment that the bad guy wanted you to open. And so what we're seeing is don't click on those hyperlinks that say, hey, your account has been closed due to violations of terms. You click on that hyperlink, it brings you to a fake site that has you enter in your credentials. And now I have those as well. So what we want to make sure that we're doing is really paying attention to what we're doing within those emails and our text messages, or even the packages we get at home. We just want to make sure that we have that sense of skepticism, if you will, looking forward and saying, all right, well, is it going to be slower for me to reach out to somebody and verify that this is actually the right thing? Or is it going to be slower if my entire account gets hacked and compromised and they have to take down my systems? Now, here's another part of that phishing email. What we're seeing here, and this isn't too abnormal still, we're still seeing these kind of attacks, is that the salutation, if you look at it first, it says, "Dear user." Now, like I've said, people have started going through and they're really starting to customize it. But as soon as you see something like this, don't pay attention to it. Realistically, if it opens up as a "Dear user," most of the time it's either a sales email or a spam email. So you don't really need it unless you're in the part where you're actually trying to actively shop that. Now, if you're actually trying to shop something, go ahead and reach out to that person individually, but don't start looking into these emails that are very blank, very templatized, if you will. Now, the other part here is please click here. That's that hyperlink I was talking about. Let's not make the mistake of opening up those hyperlinks. One of the things that you can do on your personal computers is if you see a hyperlink, hover over that hyperlink and see where it's actually leading you. Is it going to lead you to Amazon.com, or is it leading you to 3567889 at Amazon.com, or whatever it happens to be? They're trying to figure out ways to pretend that this is a legitimate site. Now, one of the things that we have here at Eide Bailly is we actually have a phishing email that will look like, or it will actually be an Office 365 email. Pardon me. And when you click on it, it brings you to a legitimate Office login page. Now, the problem is as soon as you enter in your credentials, because you followed that hyperlink, we'll forward you to where you were wanting to go. So you don't know you ever did it, but we've collected your login. We've collected all of your password, all of that stuff. We are able to then relog you into the site you were trying to get into. But in the meantime, we have your username and password. So let's look again at phishing. We started out with that first scenario. Hey, I have your daughter. The phishing calls are getting more and more complex as well. Like I said, we're not simply staying with the dealer manufacturer warranty. We're not sticking with the timeshare presentations. The reason why those go out is because it's cheap, it's easy, and it's automated. They can just send out hundreds of thousands of those every day. What we're seeing is that they're really starting to figure out, well, now that I've done my reconnaissance, now that I know more about this person, what can I do with that information? I'm going to call and say, hey, I'm trying to reach your brother, or I'm trying to reach your sister. There's a warrant out for their arrest. I'm with this law firm, and I need them to call me back right away. Now, why would that matter? Well, if you as their sibling calls and says, hey, this law firm's trying to get a hold of you, can you call them back because they're calling me now? That gives us this idea of trust. Now, as a sibling, I'm saying, oh, well, yeah, my brother said vouch for this person, so obviously it's a real law firm. So I'm calling them back. Now, as a person, you're like, oh, well, how am I supposed to verify that this is an actual law firm? You can look it up. You can do all sorts of things. Well, it's one of those things where that's where you start figuring out, well, do I have some other kind of friends in legal? Do I have some resource that I can reach out and say, hey, is this legitimate, before I start pushing forward and start really going and saying, all right, well, I'm just going to start giving them information. We need to look at it from that skeptical standpoint and say, all right, is this a legitimate phone call? They're asking for some rather intimate information, or they're asking me to vouch for them. How real is this? Let's start doing some research. Let's look into this a little bit more. And this is one of those things where the bad guys are really just trying to figure out, well, how can I play on that emotional tug at you? So that's really what they're getting to. When we look at the phone call that my friend had earlier this year, it was really this idea of trying to just stir that guttural emotional reaction. Because when we're emotional, we're not going to make the same decisions that we would have otherwise. Once again, let's look back to when you're in high school or in college, that idea of test anxiety. There have been studies over and over and over about test anxiety, and how when people are anxious, or when people are stressed, or they're emotional, they score much lower than if they were calm, clear-headed, whatever it happens to be. You can get SAT and GRE scores thrown out if you have extenuating circumstances saying, all right, this is the reason why my test should be invalidated. And they can go through and say, oh yeah, well, you had sirens going off in the classroom, or the fire alarm went off, or there was an accident that caused you to miss the testing window. Those sort of things, those testing agencies have said, all right, well, those are reasons why you were under emotional distress, you weren't able to test properly. Let's go ahead and reschedule a new test for you. When we look at this idea of the bad guys coming after us and saying, all right, well, I'm above average, I'll be okay. They're not going to come at you with this idea of, all right, well, I'm going to come at you when things are perfect. The sun's shining, you had a great breakfast, you've already had your coffee, all of this other stuff that's saying, all right, well, I'm ready for this attack. Nobody is going to be super ready for the attack when they fall for it, because oftentimes what they're doing is they're really trying to figure out, well, what are the emotional strings that I can pull at? Say, I looked on your LinkedIn, I see that you're open for work. I'm going to reach out to you saying I'm a recruiter, or I have a job offer. We're going to have an interview. I'm going to have you send me some information that way. What kind of information can I get? Hey, I got a job. Things are great. I was really hoping for this. Go ahead and send me your tax information. I get your direct deposit information. What all do I need from you? What all can I get from you? Stringing you along, this idea of catfishing you and getting this information. Let's say I looked online and I saw that you had a loved one passed away. I'm calling saying, hey, I'm trying to collect a debt for so-and-so, or I'm a friend of so-and-so, and I want to send out my condolences, and whatever it happens to be. We're trying to figure out times when people are emotionally weak, or the bad guys are trying to figure that out, so that then they can pounce on, they can attack. It's no different than the bereavement scams that we've had for years and years and years, but now they're doing it through a digital means. Here's a quick example of a smishing text message. So smishing is the idea of bad guys trying to get to you through your text, your text. Now, there's a few different ways that benefits that they can get through smishing. One of the big ones that have been going on in the last couple of years is just sending you just some of the most absurd things possible, whether that just be bad screenshots, or let your imagination run. Things that are like, what the heck are they sending me this for? Who is this person? And so you respond, stop. Quit sending me this. Whatever you happen to be sending, it's that idea of, Well, now I verified that this is an actual phone number. This is a cell phone number. What else can I do? So if you respond, it opens up the door for more attacks. So what's the solution for that? There's different tools that you can install that have filters that'll say, all right, well, I don't want to receive phone calls or emails or texts from this person on my phone. Just like you do if you were to do a block call, there's different things that allow you to do that with text messaging. Now, when we're looking at our smartphones, the biggest thing that we're running into is that the reality is most smartphones now have more processing power than most, well, I'm going to say everybody that was on the presenter side of this had when they were going through school. The computing power that are on our smartphones are so powerful now. They're just little mini computers, and they have a lot of data or access to a lot of data. And so when we're looking at this, what we're seeing is bad guys are using this as a way to get in charge of your phone, take control of your phone. Now, what all can I do from there? I can get onto your banking software if you have that installed. I can get to your contact list. I can figure out what's important to you. So when I start making those phone calls or start sending those emails, I can really customize it for you. So those are the sort of things where we go back to that idea of, if you didn't ask for it, don't open it. If you don't know the person texting you and it has some sort of attachment, some sort of link, this one was actually sent to my phone. Hey, your AT&T bill has been paid. Click here to get your free gift. Don't open those sort of things. AT&T is my service provider. How did they figure that out? Well, my phone number's out there everywhere. So they typed it in, they found out what my service provider was. Years ago, T-Mobile was real bad about saying, hey, we have this phone number on account belonging to this person. Now, as I'm looking through a lot of different websites, I can find cell phone numbers. Now, what I can do is if I think, all right, well, maybe this is a T-Mobile account, I'm going to call T-Mobile with with an application on my phone that spoofs my phone number to look like whatever phone number it is. So let's say I'm calling somebody in Texas and I want to be a Texas resident. I'm just going to find somebody that's actually a Texas resident, use their phone number and pretend to be that person. That's what the bad guys are doing. They're calling and saying, all right, well, can you validate that this is my phone number? I've called banks, several banks at this point in time, that was the only form of validation that they needed before they gave me any account information. It's like, oh, well, yeah, we have your phone number. We use the caller ID. Here's your bank balance. And oftentimes I'll sit there and I'm like, oh, yeah, I used to be able to log on online. I can't remember my login. I got a new computer. Can you give me my account number? I get the account number too. So now I have the account number, I have the balance. I know what all I can get from this person as a bad guy, as pretending to be the bad guy. So what it really boils down to is what kind of information do they want to get? So if we think back to that Conti ransomware group, where they have an entire org chart. When we're doing this at Eide Bailly, we're pretending to be the bad guys. Most of the time, it's me and another person working on the account. The bad guys, they could just be getting groups of people working together to get this information. If we look at the FBI shutting down the Genesis website earlier today, there was 80 million accounts. And so they're trying to gather information that are building out these profiles. So when I said earlier, they had fingerprints, they had all of the other information, your security questions tied into this portfolio, so that when I'm doing things like, say, I'm calling your bank and they're asking me, well, what's your mother's maiden name as your security question? Awful security question, by the way. If anybody has that set up, it's really easy to find your mother's maiden name, because more than likely you've had somebody in your family die. As sad as it is to say, I'm going on your obituary and I'm trying to find the mother's maiden name, because almost always that's going to be listed. And if I can't find it that way, I'm going to start looking at LinkedIn, trying to figure out, or Facebook, trying to figure out, well, does anybody in your family have a hyphenated maiden name? Can I find your mother's maiden name that way? There's a lot of different ways that I'm going to find that. So as we're gathering this information, we're building bits and bits and pieces to build out this whole portfolio of who you are. So I can start figuring out, well, can I steal this person's information? Or can I pretend to be that person so that I can use it to get somebody else's information? So what we really need to do is figure out, well, how big is my digital footprint? For those of you that aren't aware of what a digital footprint is, it's just that idea of how much of your information is online. like I said, if you haven't done so already, I would Google yourself. Try to figure out, well, click on that images tab on Google. How many of your images are sitting out there in the wild? How many things can people gather because you have a lot of information? Now, on top of that, let's look at all of the people that we care about. For those of you whose parents are oversharers on Facebook, unfortunately, mine is too. I had to unfriend my mom because she wouldn't quit posting stuff. She wasn't very happy with me at the time, but I think she understands for the most part. I've explained it to her several times. It's like, Mom, you can't post where you're going on vacation every week. You can't post things about my family when you're out here. Everybody knows that you're out. And then when they look at it, they're going to find my mother's maiden name. They're going to find out where she honeymoons. She's going to tag me in different things, all of that sort of thing. So look at your loved ones. What are they doing to put themselves at the potential of being attacked? And so what we need to do is figure out, how can we talk to those that we care about to help make sure that they're not attacked? Because if they're attacked, there's a good chance that we're attacked, or somebody else is attacked. We want to make sure that what we're seeing is we're going through and verifying that as much of our information that we're putting out there isn't putting us at risk for a bad guy to start either pretending that they're us or figuring out ways to attack us or those that we care about. So as we look at D, I liken this to when you go to the beach and you shove your wallet and your smartphone or your watch into your shoes. One of those things is like, oh, nobody's ever going to think to look there for my valuables. When we're doing a physical penetration test or we're doing things, we're trying to do a clean desk policy, we are always checking under keyboards. We're checking under keyboards. We're checking on whiteboards. Where can we find passwords? We did an auto dealership one time, and the password was written in Sharpie on the wall in front of the computer. So you're not alone when you do that, but know that as we're pretending to be bad guys or as bad guys, they go through, and those are some of the very first things they're looking at. Now, you might say, well, what are they doing in the office? How are they getting underneath my keyboard? We also do different tests where we pretend to, we walk in and we do physical assessments. We figure out, well, what is the security? Is anybody ever going to stop me as I'm walking around in a random high-vis vest? I'm wearing an orange vest and a hard hat, and I have a ladder. Nobody's going to stop me. There's actually YouTube videos of teenagers doing this and saying, hey, how far can I get into X by pretending to do this or just wearing this? It's a big thing. It's a big trend. They were like, well, let's see, can I get into the Super Bowl? Can I get into this concert? We can get into your office most of the time by either just following somebody in, hanging out for janitorial. It's one of those things where we're going to get in. Now, if you leave your password under your keyboard, that's a great place for me to find it. Now, the biggest thing on here is that, yes, sometimes. Why is it a big deal if you reuse your password? You know, when I was in college, I probably reused the same password all through college. It was probably, I think it was my high school nickname with the year that I graduated from high school. It was a real secure password. Now, when you look at that, one of the things that we need to pay attention to is that idea that, well, 80 million accounts were hacked, were compromised just recently or just released on that website. Now, if we look at a site called haveibeenpawned.com, PWNED, if we go on that, all one word, you can actually put in your email and say, all right, well, this is my email that I use for signing up for, you know, Facebook, you know, when I go out to eat, whatever, I want a free lunch, go to Chipotle, they have my email address, whatever it happens to be. You go onto that site, you can actually see, well, how many different sites have been pawned? How many sites have been hacked? What is that account compromise looking like? Now, if you have an account that, even if you're using, let's say, I'm best case scenario, I'm using 30 characters. It's a passphrase. I'm not using a single password with complexity, with digits and exclamation points and things like that. I'm using a passphrase. Now, if I'm reusing that same passphrase on multiple sites, say I was using it for my Ring account, or I was using it on Pandora, or I used it on LinkedIn, as soon as those accounts have been compromised, if something has happened where the bad guys now have those passwords are never good again. I can put it into a computer and I can run it through a script, and that script is going to start figuring out, all right, well, these are the password combinations that have been known to be bad, and I'm just going to push that into the system, and I'm going to be able to crack that password a lot quicker. I can go on to different hacking websites and pay, you know, a couple $100 for multiple terabytes of bad passwords. So if you've reused your password or you are reusing your password, the likelihood of that password being already in somebody's database that they can run through and start just pushing into a system to try to get through is very high. So you should never reuse passwords. And one of the things that we recommend is that you use a password manager. Now, that comes in with its own level of security risk, right? For those of you that paid attention to some of the recent attacks, LastPass was actually just compromised, and the master password that you used to get into LastPass, which is a password keeper, was also compromised. So you had to go through and change all of those as well. The biggest thing is that when you're going through that, you're verifying, hey, I'm not using the same password for my Pandora that I'm using for my banking account, or I'm not using the same thing for Facebook that I'm using to get on my LinkedIn account. Whatever it happens to be, the likelihood is if you're reusing those passwords, you really should stop doing that. So when we're looking at this, this is an idea of some of the most common passwords. Now, on the next slide, I'll explain to you what this 1 second is, but these are some of the passwords that what we're really seeing. Typically in the background here, my camera's a little bit more zoomed in here. I have a whiteboard that says Wi-Fi password 12345. It's really just a joke for myself, but it's one of those things where, unfortunately, we see this all the time. Not only do we do this, but we also see what's called the default password. So anytime you get a device at home, it's going to have the manufacturer's default password on it. Now, I live in an area where we have Comcast as our internet service provider. And for a long time, Comcast had a single password, but then they started printing them on the bottom. Now, there's also tables that have all of the variations that Netgear, Comcast, whoever it happens to be, are starting to change that password from the default password to password. However, for a lot of the commercially available items, there are also things that say, well, the password for the admin account is still admin, or the password for guest is guest. And so when we're looking at that, what we really need to make sure we're doing is, one, eliminating the usage of passwords that are known to be bad, or known to be the most common, or passwords that are known to be the default passwords. Now, when we look at that, if we look over on the right-hand side of this chart, what we see is the idea of, well, what does it mean for it to be instantly compromised? I said earlier that I can put different things in a computer program. Well, when I'm trying to figure out how to break a password, I have a computer program that is installed by an open source distribution, very similar to, if you're familiar with Ubuntu, or a Windows distribution, where it's the idea that I can start using it. It's already pre-installed, and I can put in all of the different password combinations that I can think of, or that I've downloaded, I've purchased. And as soon as I put that in, it's going to spit it out and it's going to give me the actual password. Now, if you're only using 4 characters, it's going to be instant. Doesn't matter what it is. So one of those things that we're looking at when we see, all right, well, let's take, for example, most of you with your home personal PCs, if you had to set up a PIN, oftentimes you set it up with a 4-character PIN, because that's the default by Microsoft. To say, oh, well, I'm just going to set up 4 characters. Now I can use number and symbols, but this is my home computer. What's the big deal? Well, most of us are using laptops. So if I broke into your house, I have access to instantly break that computer. Now, when we look up, we next step up, we're doing 5. Now let's skip all the way down to 11. If we're only using numbers, it's going to be 2 seconds, real quick. We move all the way over to using uppercase, lowercase, numbers, and symbols with 11 characters. It takes a lot longer. It's 400 years. Now, all of this was put out prior to the new generation of graphics cards. Now, as graphics cards continue to get bigger and better, these numbers shrink. There's a certain point where they stop shrinking as much, but the new graphics cards make this a lot faster, because that's what we're leveraging as our computing power to really start figuring out, well, how can I get through this? And this brings us to the idea of what a lot of cybersecurity experts are trying to figure out now is, once quantum computing comes out and we can start using whole banks of computers and all of that other stuff that are using a lot of power to really figure out how to break your password, we're going to have to figure out ways to get past this, which is why a lot of companies are starting to talk about going passwordless, and using different forms of identification. What we're looking at here, when we look on the left-hand side, is what we want to make sure that we're not doing with our passwords is using anything that I'm going to be able to find as I'm doing my research, as I'm really trying to figure out through your social media. All right, well, I know what your pet name is. You posted it all over Facebook or Instagram. It's like, this is Joey. So I'm going to use Joey as my password. Or if I figured out, hey, this is where you honeymooned, I know that you honeymooned in Cancun. So I'm going to do Cancun. Oh, and I can also see what year you were married. So I'm going to use Cancun 05 or whatever it happens to be. I'm going to start figuring out and trying to guess that. I'm going to put it into my password generator and try to figure out how can I get into your information. One of the biggest things that we want to make sure that we're doing as well is when we have the option for multi-factor authentication, we're turning that on. Now, I know that for a lot of people, when they look at multi-factor authentication, they're like, man, I just don't want to have to keep jumping through all of these different hoops to get into whatever it happens to be. Now, this is where it really comes down to your personal preference. I'm not going to say that you need to do it every time that you have multi-factor authentication, every time you log in to listen to your music. But for your bank account, you should have multi-factor authentication turned on. And it should also make sure that you're being logged out. One of the things that bad guys are also doing these days is they're stealing what's called your session token. Anytime you come up and it says, all right, well, here is, we're going to save your information with a cookie. Just recently, one of the most popular YouTubers has, I think, 15 million subscribers, talks about tech. He got hacked because they stole a session cookie. So that idea of being able to stay logged in, that's what happened. They stole that login session. They were able to log in, they locked him out, and they uploaded videos linking to a cryptocurrency and then kept him out of his account at 2 a.m. so that he wasn't able to get back in. People were going to this cryptocurrency account thinking, hey, this is real. And then his YouTube account was suspended because YouTube caught it. I'm going to go ahead and answer some of the questions that have come over. Just make sure. Do I have anybody that has questions? Oh, here we go. So I have one that says, have noticed a significant increase in recent years in email newsletters that I've never signed up for, become hesitant to unsubscribe. Yeah, so what we're seeing is, and she asked, do I have best practices on what you should do with that situation? So rather than clicking unsubscribe on ones that you haven't signed up for, or even ones that you have signed up for, you can go through, and almost every email provider allows you to just block that email. And so you can do a web search on that particular topic, or a search through your email saying, let's say I all of a sudden started getting emails from goat farms and I don't have anything to do with a goat farm. Well, I can search for goat farms and it'll bring up all of those email addresses, and I can do a mass filter on most every website or email service provider, whether you're using Yahoo, Gmail, Outlook, and then include those in on things that are going to be automatically blocked. And so making sure that you use that to go through and do it that way. I wouldn't click on any of those links that say unsubscribe, especially on ones that you don't know, because there's a good chance, or there's a possible chance that you're clicking on that hyperlink that takes you somewhere. Now, if you think that, hey, this is a lot of work, I don't want to do it that way, you can always go to their website and click unsubscribe. But then you're also putting in your email to verify that is your account. So just, whatever way is most convenient for you or makes the most sense to you, I would do it the blocking way, but you can go and unsubscribe. But I wouldn't click on the link ever. The other next question I have there is using a password manager like Bitwarden useful even if you reuse your password? So oftentimes with these password managers, they'll give you a warning saying, hey, we see all of these various sites that have that are using the same password. Now, if you're using, when I say a password manager, I'm not including things like Microsoft Edge or Google Chrome where it says, hey, save this password to your browser. One, I would never do that. That's a bad practice, because if I can get on your computer, I can get into that. I'm going to be able to figure out how to get onto those passwords. Those aren't as secure as the password managers. But as we're going forward, if we look at just those password managers, oftentimes the ones that I've used, what they recommend is, hey, we've noticed that you're using the same password for Kroger.com as you are for Pandora, as you are for whatever it happens to be. They'll recommend that you change those, and they can create automated passwords up to 15 characters oftentimes, or you can set how many characters you want, if you want it with complexity, all of that sort of thing. So that's adding numbers and symbols and sort of things like that. Do I have a recommendation on a good password keeper? The biggest thing that I always recommend, and I'm not going to try to sell you one or the other, is that you should always be paying something for your password keeper. There's a reason why things are free. Whether you're thinking about Facebook or you're thinking about LinkedIn, or you're thinking whatever it happens to be, the grocery store rewards card you signed up for, all of this is free because they're collecting data on you. And so as you're going through and you're looking at for a good password manager, I would recommend that you look at is it beneficial to me based on the cost? How much am I willing to spend on it? Most of them are around the same price if you're looking at OnePass or LastPass, or if you have like a malware detection on your computer. So if you're using like Trend Micro or Norton, all of those are going to come with password managers. And so really trying to figure out, well, which ones makes the most sense to me? If I'm using Office 360, or if I'm using Microsoft at home and I don't have a password of antivirus, maybe pairing that with an antivirus with the password manager would make sense. And then the last question, or I have a couple more. How susceptible are password managers themselves to being hacked? So the reality is that it's like anything else. Nothing is going to be completely secure. I think I heard somebody the other day quote, it was an old, I think he was an FBI director, said the only secure system is one that's powered off in a lead-lined room and then surrounded by guards or something along that, with like an 8-foot fence, barbed wire fence. The reality is if it's online and it's answering to entering information and people can log in, it's susceptible to being hacked. If we look at organizations or entities like healthcare, one of the most regulated entities in the nation, they're also the most compromised, hacked information in the entire systems every year. So they lose more money every year, and they're the most regulated. When we look at password managers, it's one of those things where you have one source of making sure that if and when it's compromised, you're going through and you're fixing all of those passwords, and they're keeping track of it, right? Versus if you're not using that, and let's say you're not paying attention, that the news blip came over that, Uber got hacked. If you have an Uber account and you've been using the same Uber account for the last year, your account has been compromised. Uber sent out a message, but they weren't real good about it. They didn't send it out as like a, hey, urgent kind of thing. It's one of those, hey, at this point in time, we're not sure how many accounts have been hacked, but we're letting you know because we're legally required to. Uber has been hacked. Almost everybody has some sort of banking or credit card information attached to that. Personal identifiable information was released through that. So you need to be making sure that you can pay attention to those sort of things, and being able to have that password manager just makes that a little bit easier. The last question I have, does it make good sense to delete old contacts, LinkedIn, Facebook, et cetera, to reduce exposure? Somebody threw out there earlier that, did I really, unfriend my mom? And the answer is yes. I actually unfriended all of my family members on Facebook. One, because I don't use Facebook for anything other than hacking people. As a good guy, I do it when I have a signed letter of statement of work, but I don't use Facebook for anything else. And so when you're looking at, if you're actually using these websites, when you look at LinkedIn and things like that, if you know the person, stay connected to them. If you're not looking for a job or you're not actively posting and things like that, set your profile to private. Don't let other people find you, whatever it happens to be. You should keep your information as secure as you think, as you should be comfortable with. Now, I know that as a security professional, and I'll admit this openly, that I am more paranoid than most people are. But tie that into the fact that I see all of these attacks day in and day out. It's one of those things that causes me to be paranoid. And so when you're looking at your personal stuff, as you're looking at it, make sure that you have your privacy settings on there. Make sure that anybody you're connected to that has ability to see your information also is private. So I do recommend on cleaning that sort of things up to just kind of limit your exposure, or shutting it down altogether if you're really not using it. I don't believe I have any other questions that have come across. I'm going to bring up my last slide here. So the key takeaways for you guys, really want to make sure that you understand that the threats, the bad guys are always changing. There's money to be made. And so if they can put in a little extra time to make more money, they're going to do it. So the idea of I'm good where I am now is just a bad thought, because everything's going to change. Just like you guys were talking about earlier in this session about all of the different forms that are continuously changing. As Leland talked about, being around for 36 and now it's on 100. The bad guys are changing too, to deal with the times, deal with all of the different things that everybody's required to do with regardless of their organization, so that they can attack you better. Cybersecurity really relies on everybody. If we're letting one person slip, all of it's going to slip, and we can start getting through that gateway. I like to compare it to this idea of back when you were a kid. For those of you that were able to do it, there was a game called Red Rover, and when you're looking at it and you see across the aisle and you see two people that are like, oh, well, I'm going to break through that hand grip, so I'm going to run through there. That's what we're looking at, is we're playing a big game of Red Rover, and all of us need to come together to make sure that the bad guys can't get through. And then the last thing is really you want to make sure that if you have any questions, you stop, you think about it, and you're figuring out, well, is this legitimate? Are they really trying to get through my defenses? Or are they just, am I doing enough to protect myself? So once again, my name's Chris Williams. Here's my information for anybody that has any more questions. Feel free to reach out to me, or like I said, reach out to any of your partners here at Eide Bailly.